Please like, share, and subscribe. Wishing you happiness and good luck every day.
What if I told you that the blueprint for the biggest financial meltdown of our lifetime was basically laid out during a single lunch? Yeah, a meeting back in 2005, years before the whole world economy just went off a cliff. It was between a sharp Wall Street insider and, well, the most famous investor on the planet. So let's get into it, because this isn't just a story about lunch. It's about two completely different ways of looking at the world, and what happens when one of them goes horribly, catastrophically wrong. So here are our two people at the table. On one side, you've got the Oracle of Omaha himself, Warren Buffett, and on the other, Janet Tavakoli, a seriously brilliant expert in structured finance who could see the rot in the system from the inside. And that quote you're looking at, it just says it all. The irony is just staggering. There they are, sitting in a quiet restaurant, talking about the cracks forming in the system, and they have absolutely no idea that the system wasn't just cracking. It was already in the middle of a full-blown collapse. All right, so how did one lunch basically predict a global collapse? We're going to unpack this whole thing piece by piece. First up, we'll look at the unexpected invitation that brought these two together. Then, we're diving straight into the Oracle's warning, the real heart of their disagreement. We'll see how Wall Street's so-called princes of darkness completely ignored that warning, which led to a massive meltdown and the government's panic response. And finally, we're going to talk about integrity, a huge piece of this, and pull out the final, timeless lesson from this incredible meal. Okay. Let's set the scene. You gotta picture it. The year is 2005. The financial world thinks it's invincible. The markets are just roaring. Wall Street is printing money hand over fist with these super complicated products that, honestly, nobody really understood. It's that classic calm before the storm, that eerie quiet right before the hurricane makes landfall. Now, you have to understand who these two people were. Janet Tavakoli, she wasn't just some talking head on TV. She was a former chemical engineer with a top-tier MBA, and she was serving as an expert witness in huge fraud cases involving the very same financial products that were about to blow up the world. She ran her own elite consulting firm, and then, completely out of the blue, a letter shows up. It's from Warren Buffett, years after she'd sent him a copy of one of her books. So in August 2005, she gets on a plane to Omaha, and this historic meeting happens. Okay, so let's get to the heart of their conversation, because this wasn't just idle chit-chat over steak. This was a clash of worldviews, a fundamental disagreement about the right way to measure risk, the right way to figure out what something is actually worth, and the fatal flaw that was hiding in plain sight inside all of Wall Street's fancy computer models. This is such a critical point. See, Tavakoli suggested using computer programs to sift through data and find good investments. And Buffett was kind of like, nah, I don't need them. And you have to wonder, why not? Well, as she quickly realized, it's because his decades of reading thousands of annual reports, of deeply understanding how businesses actually work, all that knowledge had built a model inside his own head that was way more powerful than any algorithm. He had this mental database of business knowledge that no computer could ever hope to replicate. And this right here shows you the massive difference. The Wall Street models, they were basically trying to drive a car by looking only in the rearview mirror. They were built on what happened yesterday, assuming tomorrow would be exactly the same. But Buffett knew that in the real world, things change. His approach wasn't about price, what you pay. It was about value, what you get. It sounds simple, but that distinction is everything. And if you want Exhibit A for this kind of flawed thinking, look no further than the CDO. This was the weapon of mass financial destruction that caused so much damage. The idea was to take thousands of really risky mortgages, loans to people who probably couldn't pay them back, bundle them all together, and then, through some financial wizardry and a bogus stamp of approval from the credit rating agencies, call the whole package AAA, ultra safe. It was literally a system designed to turn garbage into gold, and it just doesn't work that way. So that was the theory they talked about over lunch in 2005. Now, let's flash forward and see what happened when those theoretical flaws ran head-on into reality. This is where the whole house of cards starts to come crashing down. The first big domino to fall was Bear Stearns. In 2007, two of their big hedge funds just imploded. And guess what they were filled with? They were stuffed to the gills with those exact same toxic CDOs. The managers were telling investors, everything's fine, nothing to see here, even while they were sending internal emails saying the entire subprime market was toast. By March of 2008, the entire company, an 85-year-old institution, was gone, sold for pennies on the dollar just to stop it from taking everyone else down with it. You know, the Bear Stearns collapse is a perfect example of what Tavakoli called her own law. And it's really simple when you think about it. Before you factor in fees, active investing is a zero-sum game. For every person who beats the market, someone else has to lose to the market. So for every hedge fund manager posting these unbelievable genius-level returns, there has to be another one getting absolutely wiped out. The industry just uses leverage and complexity to hide that simple fact. So here's the dirty little secret. A lot of these hedge fund stars, they weren't geniuses. They were just gamblers. They were willing to take on way more risk than anyone else, often with borrowed money. They were making these wild bets, and when the bets paid off, they looked like heroes. But when they failed, they didn't just fail. They blew up spectacularly, taking a lot of people's money with them. So now the fire isn't just on Wall Street anymore. It's spreading, and it's threatening to burn down the entire global economy. This is the moment when the government, which really should have seen this coming, is forced to jump in with a desperate, chaotic attempt to put out the fire. Just take a second and look at that number. $85 billion. And get this, that wasn't a stimulus plan for the whole country. That was an emergency loan to one single company, the insurance giant AIG. And why? Because AIG had been acting like a casino, basically selling insurance on all of these toxic assets without having the cash to pay out when they all inevitably failed. If AIG went down, it could have taken the whole system with it. So in the summer of 2008, panic is absolutely everywhere. And Treasury Secretary Hank Paulson tries to calm everyone down. He goes to Congress and asks for a blank check to prop up the mortgage giants Fannie Mae and Freddie Mac. And he uses this now infamous analogy. He says, if you have a bazooka, you might not have to use it. The message was clear. Don't mess with us. We have unlimited firepower. Well, here's the punchline. He had to take the bazooka out, and it wasn't nearly big enough. The problem was just so huge. The government had to completely take over Fannie and Freddie. Then Lehman Brothers collapsed. And then they had to turn around and pump that $85 billion into AIG. The bazooka wasn't enough. They needed an entire armory, and they were making it up as they went along. And this brings us right back to one of the most important things they talked about at that lunch in Omaha, because this whole crisis wasn't just a failure of spreadsheets and models. At its heart, it was a failure of character. It forced everyone to ask a really tough question about the difference between what's legal and what's right. Right in the middle of all these scandals, Buffett sent out this memo to his own managers, and his point is just so profound. He said, you can have a rule book that's 1,000 pages long, but if the culture of a company is rotten, people will always find a way around the rules to do the wrong thing. He believed that a strong ethical culture is the only real defense. And if you want to see what a failed culture looks like in the real world, here it is. We're talking about executives secretly changing the dates on their stock options to guarantee themselves a payday. We're talking about pushing toxic loans onto people who had no chance of paying them back, lying to investors about risk, using legal loopholes to cheat people. And through it all, the executives who created the mess just deny they had anything to do with it. This is what happens when the only question anyone asks is, can we do this, instead of, should we do this? So what's the alternative? Well, Buffett has this brilliantly simple test for how to behave. He tells his people to forget the lawyers and the complicated rules for a second. Just ask yourself, would you be okay with what you're doing being described in detail on the front page of your hometown newspaper, where your friends, your family, and your neighbors could all read it? It's an amazing standard, and it's a test that would have prevented almost every single disaster of the financial crisis. So let's bring it all home. Let's go back to that lunch between Janet Tavakoli and Warren Buffett. After looking at the catastrophe that followed, what's the ultimate, timeless lesson we should take away from all of this? I think this table just sums it all up perfectly. The entire crisis was basically a battle between these two columns. On the left, you've got the Wall Street way, complexity, formulas, leverage. On the right, you've got the Buffett way, simplicity, fundamentals, and a margin of safety. The world learned the hard way what happens when you choose the column on the left. And maybe this is the single most important lesson of all. It comes down to this incredible quote from Buffett. See, Wall Street built these unbelievably complex models that gave them this false sense of security. They thought they had risk calculated down to the 5th decimal place, but their core assumptions were garbage, so they were precisely wrong. Buffett, on the other hand, just focuses on being approximately right. And let me tell you, being approximately right is infinitely better and a hell of a lot safer than being precisely wrong. Which leaves us with one last nagging question. The financial system we have today is even more complex than it was back in 2005. You've got high-frequency trading, AI-driven strategies, a whole new universe of digital currencies. The models are more powerful than ever. So the question for all of us is, have we really learned anything? Have we learned that simple, fundamental lesson from that prophetic lunch in Omaha? Do we truly understand the difference between price and value? Between what we pay and what we actually get?
All right, let's dive into a fascinating story. It's about a simple invitation, a letter that could have connected two of the most powerful minds in finance. But this isn't just about a meeting. Oh no, it's about a critical warning, a 2-month delay, and a conversation that was, frankly, way more important than anyone realized at the time.
Can you imagine getting this in the mail? A personal invitation from Warren Buffett himself. You know, the Oracle of Omaha, one of the richest people on the planet. And look what he wants to talk about. Credit derivatives. This wasn't just some friendly chat. This was him basically saying, let's talk about the thing I think might blow up the world. It was less of an invitation and more of a summons for a high-level debate.
But here's the kicker, the part that's just wild to me. For 2 whole months, that letter just sat there, unanswered. The person who got it, Janet Tavakoli, wasn't some nobody. She was a top expert who literally wrote the book on this stuff. And she was so deep in the trenches of the financial world that even a letter from Warren Buffett had to get in line. And why it took so long? Well, that pretty much tells you everything you need to know about the world she was living in.
Okay, so to really get the weight of this moment, you have to understand the two people at the heart of this. We're not just talking about two successful people. We're talking about ideological opposites. They represented this huge fundamental conflict right at the core of the entire financial system.
So in one corner, you've got Janet Tavakoli. They called her the Cassandra of credit derivatives, like the mythical prophet who was doomed to be right but never believed. She was a Wall Street insider screaming about the hidden dangers. And in the other corner, you have the legendary Oracle of Omaha himself, Warren Buffett, looking at this whole system from the outside with just deep, deep suspicion. One was an expert who knew how the machine was built. The other was a powerful skeptic who was terrified of it. They were on a collision course.
So what was this big conflict all about? Well, it all boiled down to one of the most powerful, misunderstood, and frankly terrifying tools in modern finance: derivatives. The very thing Buffett wanted to talk about.
So what the heck is a derivative anyway? Well, at its core, it's just a bet that something will or won't happen in the future. But, and this is the part that changes everything, it's a leveraged bet. Think about it like this. It's like using a tiny handle to control a massive hydraulic press. With just a little bit of your own money, you can control a huge financial position. It's how people make absolute fortunes overnight, and it's how they lose everything in the blink of an eye.
And Buffett, well, he was not subtle about how he felt. In his 2002 letter to his shareholders, he dropped a line that sent absolute shockwaves through Wall Street. He called derivatives financial weapons of mass destruction. I mean, what a phrase. It just perfectly captures the level of danger he saw. And this wasn't just him being clever. It was a conclusion he came to after some really bitter first-hand experience. So where did this extreme view come from? Why weapons of mass destruction? Well, it was born out of a years-long, painful headache from a business he bought that was full of these things. It was a mess.
Yeah, Buffett's hatred for derivatives was earned the hard way, over a decade of just awful lessons. It really started with the Salomon Brothers scandal in the early 90s, but the real nightmare began in 1998 when he bought a company called General Reinsurance. He thought he was buying one thing, but he inherited this derivatives unit that he called his problem child. It was a total black box of tangled up long-term contracts that were just hemorrhaging money. His struggle to unwind that mess is exactly what led him to write that famous warning in 2002.
You know what really horrified Buffett? The accounting. He realized that the values these banks were putting on these contracts, they were basically made up, pure fiction. There was no real market to price them, so they were just using these super complex models to guess. He had this incredible line. He said it wasn't marked to market, it was marked to myth. He realized a huge chunk of the global financial system was built on imaginary numbers, and that rightly terrified him.
And here's a crazy little twist in the story. Their paths had almost crossed years before at the legendary, or maybe infamous, investment bank Salomon Brothers. Tavakoli was there in the mid-'80s, right in the thick of it, part of the generation that was building this modern derivatives machine.
Buffett showed up in '91, but for a totally different reason. He was there to clean up the catastrophic mess that machine had made. It's like one was the architect and the other was the guy they call in after the building collapses. Two ships passing in the night, sailing in completely opposite directions.
So all this history, this conflict, it brings us right back to the summer of 2005 and that unanswered letter. And suddenly, Tavakoli's 2-month silence starts to make a whole lot more sense, doesn't it?
So, what happened? Why the delay? Well, the letter landed on her desk in June, right when she was locked in this absolutely brutal legal fight, a massive securities fraud case worth hundreds of millions, and she was the star expert witness. After this grueling 2-day deposition where she basically dismantled the other side's entire case, she took a much-needed week off. It wasn't until August 1st, when she's finally clearing out her to-do pile, that she finds this single, solitary item left, the letter from Omaha.
And she replied right away. No excuses. She was totally upfront about it. She said, look, I don't have any business in Omaha, but this is a conversation I want to have. She said she'd be happy to fly in specifically for the meeting, and she even offered up 3 dates in August.
So after 2 months of radio silence, you gotta wonder how the famously busy Warren Buffett would respond, right? Well, the answer came back almost immediately. No games, he was clearly just as eager to have this conversation as she was.
And in classic Buffett style, he replied just 2 days later. Total humility. He didn't suggest some 5-star restaurant. He just said he'd take her to a place with no decor but good food. The message was clear. This was about the conversation, not the spectacle. And just like that, the meeting was on, August 25th.
So on a hot August morning, Janet Tavakoli gets on a plane headed for Omaha, Nebraska. Here she is, this self-made expert, a woman who was both respected and feared on Wall Street. But the person she was about to meet, he was on another level entirely, a living legend, an investor who made most of his billions after the age most people are thinking about retirement. She was walking right into the oracle's den.
Which brings us to the ultimate question, doesn't it? When the insider who saw all the flaws up close finally sits down across the table from the powerful critic who called her entire industry weapons of mass destruction, what on earth do they say to each other? Is there any common ground? Could they find a way forward? The stage was set for what could have been one of the most important financial conversations of the entire decade.
Imagine this. What if you could spend 4 hours, just you and Warren Buffett, picking his brain over a quiet lunch? Not in some crowded conference hall, not from a letter to shareholders, but just a real one-on-one conversation. Well, that's exactly what we're going to dive into today. We're unpacking the key lessons from that exact scenario, all thanks to Janet Tavakoli's incredible, detailed account of her personal lunch with the man himself.
And we're going way beyond just looking at his portfolio. We're really trying to get inside his head. Because to understand the investments, you've got to understand the mind that's making them. This quote, which Buffett actually wrote to Tavakoli after their meeting, just sets the stage perfectly. It gives you a little hint of the personal, insightful, and, well, surprisingly witty conversation that reveals so much more than any annual report ever could.
So how are we going to break all this down? Well, we're going to follow the story of the lunch itself, almost like we're sitting right there with them. We'll start with the very first impression. Then we'll see this simple little test of character that says everything. From there, we'll dive into his media playbook, really decode his true investment mindset, see how he beats Wall Street at its own crazy game, and then finally, we'll talk about the Buffett effect on a really personal level.
Okay, so our story starts not in some glittering skyscraper on Wall Street, but in a pretty unremarkable office building in Omaha, Nebraska. Tavakoli gets there, the lobby's empty, and she's guided up to the 14th floor, not by a receptionist, but by this friendly but kind of disembodied voice on an intercom. It's a really mysterious but very humble start to a pretty extraordinary meeting.
And then, when the legend himself appears, the myth just immediately gives way to the man. He was taller and trimmer than she expected, wearing a simple gray suit, not to look flashy, but just to be comfortable. Right away, the picture is crystal clear. This is a person who is so incredibly comfortable in his own skin that he has absolutely zero to prove to anyone.
But you know, it was a tiny, seemingly insignificant moment that actually revealed the most. It involved nothing more than a glass of water sweating on a nice coffee table. This is what we're calling the newspaper coaster test, and let me tell you, it's a brilliant insight into who he really is.
So let's just walk through what happened here. Tavakoli hesitates, right? She doesn't want to leave a water ring on this beautiful wood table. So what does Buffett do? He gets up, grabs his own copy of the Wall Street Journal, a paper he absolutely loves, and puts it down for her glass.
But here's the real key. Tavakoli noticed that Buffett himself seemed nervous. He couldn't relax until she was relaxed. His number one priority wasn't the furniture, it was making his guest feel genuinely at ease.
This one simple act is the perfect illustration of what genuine etiquette really is. It's not about fake politeness or following some stuffy set of rules. No, it's a practical social tool. It's a conscious effort to make other people feel comfortable, which in turn allows for a real connection. It's an early clue to his entire philosophy. Put the person in front of you first. Now, that Wall Street Journal wasn't just a coaster. It actually kicked off a really deep conversation about the entire media landscape, a world Buffett knows inside and out, both as a kid delivering newspapers and now as a major investor who shapes it.
And his views on the media? They're incredibly nuanced. On one hand, he loves the status and the influence that comes with old-school newspapers, but he's also a stone-cold realist. He pointed out how the Wall Street Journal completely fumbled its chance to dominate online. He sees the internet as instant, sure, but also way less reliable. In fact, he found that blogs written by soldiers in Iraq were often more informative than the mainstream news. For Buffett, the game was never about print versus digital. It's always been about one thing: finding reliable information no matter where it comes from.
And this is the proof that he's not just talk. Unlike so many people who get trapped by nostalgia, Buffett does not let his personal love for newspapers cloud his business judgment. He acts on what he sees. So while he loves print, he saw where the future was going, which is why back in 2006, he bought Business Wire, an internet-based press release company. He invests in reality, not in the way he wishes things were.
And this practical, logic-first approach to media leads us right into the real core of this whole thing: Buffett's actual investment philosophy. And as we're about to see, it's so much deeper than the simple cliches you always hear on TV.
You can really see the contrast here between how most people think and how Buffett thinks. So many investors are looking for shortcuts, simple metrics like a low PE ratio or some complex system to sort data. Buffett relies on his own encyclopedic, almost obsessive knowledge of the actual businesses. Other people diversify just for the sake of it, thinking it's safer. He thinks the real risk is owning something you don't truly understand. It all comes down to that famous line of his: price is what you pay, value is what you get.
And the results? Well, they speak for themselves, don't they? This chart shows that over a 35-year period, Berkshire Hathaway's annualized return was nearly double that of professional value managers. These are the very people who claim to follow his philosophy. I mean, look at any time period you want, the 70s, the 80s, the 90s, it's the same story. He is consistently miles ahead of the pack.
And just to really see it clearly, the performance gap isn't just a gap, it's a massive chasm. This isn't just a story about winning, it's a story about someone playing a completely different game. A game built on solid, enduring logic, not in whatever financial fad is popular this week.
All right, now we're going to dive into one of the most misunderstood parts of Buffett's whole strategy: his success with derivatives. The very things he famously called financial weapons of mass destruction. So the question is, how on earth does he win at a game he seems to hate so much?
This is the central puzzle, right? It feels like a total contradiction, but it's actually the perfect example of his core philosophy in action. See, he doesn't play Wall Street's game by Wall Street's rules. He finds one specific corner of that game where he can apply his own rules and his own logic.
So the tool he uses is something called a long-dated equity index put. Now, in simple terms, here's what that means. Someone pays Berkshire Hathaway a huge pile of cash today. That's the premium. In return, Buffett agrees that way down the road, we're talking 15 or 20 years from now, he might have to buy a major stock market index at today's price.
And look, we're not talking about small amounts of money here. By early 2007, he had collected $4.5 billion in these premiums. That's $4.5 billion in cash sitting in his bank that he gets to invest for decades before he ever has to potentially pay out a single dime. It's basically like getting a massive, interest-free loan.
And here is the secret. It's so simple, it's brilliant. Wall Street's super complex models are all built to predict short-term price swings, what they call volatility. Buffett just ignores all that noise. His model is in his head, and it's based on one simple, incredibly powerful bet: long-term economic growth. He is betting that the American economy, and by extension the stock market, will be significantly more valuable in 20 years than it is today. You see, the other guy's model is fixated on the waves. Buffett's is focused on the tide.
And the punchline to this whole thing? It's just perfect. When Tavakoli later mentioned Buffett's strategy to some sophisticated Wall Street derivatives trader, his response was just pure dismissive ignorance. He said, "That old guy, he hates derivatives."
And that right there is how Buffett wins. He tells the whole world exactly what he's doing, and his competition, totally blinded by their own complicated systems, still doesn't get it.
You know, all these insights, from the etiquette to the media to the derivatives, they all point to something much bigger. The impact of spending time with Warren Buffett goes way beyond just investment tips. It's about a fundamental shift in how you see the world and your place in it. That's the Buffett effect. I mean, the sheer breadth of their conversation was just astounding. Over 4 hours, the topics just jumped all over the place. From the late Shah of Iran's wife, to Rosa Blumkin, the furniture entrepreneur, to Ted Kennedy, Arnold Schwarzenegger, chemical engineering, the flaws of rating agencies, playing bridge online, and the life of Katharine Graham. It was, as Tavakoli put it, like getting a private tour of his memory palace, a mind that is constantly making connections between things that seem totally unrelated.
But the most powerful moment, the biggest takeaway, came from a single piece of advice. After hearing about some difficult clients she was dealing with, Buffett just looked at her and said this: "It's so simple, but it's so profound." He wasn't just giving her business advice, he was empowering her to recognize her own value and to understand that the most precious, non-renewable resource we all have is our time and our energy. Don't waste it on people who drain it.
You know, when it comes right down to it, Buffett's entire philosophy, from investing to how he treats people, it all boils down to one thing: a relentless focus on fundamental, long-term value over temporary, fluctuating price. And that really leaves us with a final question to think about. In our own lives, where we're just flooded with data and distractions every single day, what is the essential value in our work, in our relationships, in our decisions that we might be overlooking? All right, let's get right into it. What we're going to unpack today isn't just another business story. No, this is a tale of a high-stakes war over ethics, over money, and over transparency. It pitted a legendary investor from the plains of Omaha against some of the most powerful and respected names in the entire world of economics and politics. It's a wild story about a clever, almost invisible kind of corporate theft and the dead simple challenge that could have stopped it all.
So this whole thing kicks off with this just incredible challenge from Warren Buffett, something he threw down all the way back in 1985. He basically put out an open offer to any CEO in America. He said, "You guys claim your stock options aren't possible to value, so you can't count them as a business cost? Okay, fine, I'll buy them for you, right now, for cash." And to this day, crickets. Not a single person has ever taken him up on that offer. And that deafening silence? Well, it tells you everything you need to know about the billion-dollar debate at the heart of our story.
Okay, so to really get what this fight was all about, we've got to understand the financial tool right at the center of it, the good old employee stock option. Now, on paper, it sounds fantastic, right? A way to get everyone, from the CEO down, pulling in the same direction. But, as we're about to see, this seemingly great idea had a really dangerous flaw hidden inside.
So what is a stock option? It's actually pretty simple. It gives an employee the right, but not the obligation, to buy their company's stock at a locked-in price. We call that the strike price. The whole idea is that the employee will bust their tail to make the company successful, which pushes the stock price up. And then they can cash in on the difference between that low strike price and the new, higher market price. In theory, everybody wins.
But here's the catch, and it is a huge one. This setup creates something called a moral hazard. Think about it. Executives get all of the upside. If the stock soars, they get massive, life-changing rewards. But if the stock tanks, they risk nothing. Absolutely zero. The option just expires worthless. This creates this perverse incentive to take massive, sometimes company-killing risks. You know, make a crazy acquisition, pile on a mountain of debt, who cares? If it gives the stock price a short-term pump, you get rich, and if it all blows up, well, you just walk away. Heads I win, tails I don't lose.
And if you think this is just some academic theory, well, check out this number. This is what the CEO of Merrill Lynch, Stan O'Neill, walked away with. And he got this after his firm took a catastrophic $8.4 billion write-down that was a key trigger for the global financial crisis. Now, he didn't get a bonus or severance, but he still kept over $161 million in compensation, a huge chunk of which came from options. All the reward, absolutely none of the risk. It's the perfect, and frankly terrifying, example of that moral hazard in action. Now, as if that wasn't bad enough, some executives figured out a way to rig the game even more, to stack the deck completely in their favor. And this takes us to the real heart of our story, the shocking discovery of a massive, widespread scandal that one writer perfectly described as deft theft.
The scam was called backdating, and it's as simple as it is dirty.
It's basically like having a financial time machine. Instead of giving yourself options based on today's stock price, you look back into the past, find a day when the stock price was in a deep valley, and then you just pretend, you just lie, and say you were granted the options on that day instead.
Let me walk you through how this little trick worked, because it's kind of brilliant in a completely dishonest way. Let's say today, the board decides to grant you options, and the stock is trading at $10. Okay, not bad, but you get a little greedy. You look at the stock chart for the last few months, and you see, whoa, 3 months ago there was one day where it dipped to $3. So you just falsify the paperwork, and you set the grant date to that day. Boom. Instantly, your strike price is $3, not $10. You've just given yourself a $7 totally unearned head start on your profits, all paid for by diluting the value for every other honest shareholder.
So, for years, this was happening in the shadows, right under everyone's noses. And then comes this guy, Eric Lai. He wasn't some Wall Street hotshot. He was an assistant professor at the University of Iowa, just crunching numbers. And he started noticing something impossible. He saw that a statistically unbelievable number of CEOs were being granted their stock options on the very single day that their company's stock hit its absolute lowest point for the quarter, or even for the entire year. The odds were astronomical. It was just too perfect to be luck. He knew he'd found the fingerprint of widespread cheating.
And once he blew the whistle, man, things just exploded. It started with a subtle accounting rule change in late 2004. Then, in November 2005, the Wall Street Journal got a hold of Eric Lai's research and put it on the front page. By March of 2006, the SEC was already probing about a dozen companies. But just 6 months later, that number had jumped tenfold. It was an absolute firestorm.
I mean, just look at the scale of this thing. We're not talking about a handful of companies. It went from a dozen under investigation to over 120 in half a year. By the next year, you had 85 different companies, including huge, famous names like Apple and United Health, that were forced to go back and completely restate their past earnings because they'd gotten caught. This wasn't a few bad apples. The rot had spread through the entire orchard.
But here's the thing. This scandal didn't just appear out of nowhere. It was really the symptom of a much deeper, more fundamental conflict. It was a battle of ideas about what a corporation really owes its owners, the shareholders. It was a fight for the very idea of transparency.
And it was a clash of two totally opposite philosophies. On one side, you had who Buffett called the prairie princes, guys like him. Their argument was just pure common sense. They said, look, stock options are a form of payment. Payment is a cost. You have to put your costs on your books so your shareholders can see what's going on. Simple. But on the other side were the princes of darkness. And their argument was, well, it was that this was improper accounting, that options were too tricky to value, and that, hey, the smart shareholders should just be able to figure out the cost for themselves. It was basically an argument for hiding the ball.
And listen, when we talk about the princes of darkness, we're not talking about some fringe group of oddballs. This was the A-list. The absolute establishment. We're talking 2 Nobel Prize-winning economists, 2 former secretaries of the U.S. Treasury, and other giants of the economic world. These 29 famous names literally co-signed an article arguing against transparency, throwing their immense credibility behind the very system that let all this backdating happen in the first place.
And Buffett's comeback to all this was just perfect. So logical. Their whole argument was that you couldn't value options with perfect precision. And Buffett basically said, so what? Accounting is filled with estimates like how much a factory machine depreciates. You don't just pretend a cost doesn't exist because you can't calculate it down to the last penny. It is so much better to be approximately right about a real thing than to be precisely wrong by pretending it's zero.
So as this whole mess unraveled, Buffett saw it as a teachable moment. It wasn't just about accounting rules or loopholes. It was about something much deeper, the culture of integrity, or the lack of it, inside a company. And this led him to write this incredibly powerful memo to all of his managers that contains a piece of wisdom for the ages.
He warned them. He said, the 5 most dangerous words in business, the phrase that should set off alarm bells in your head whenever you hear it, is everybody else is doing it. It's the ultimate excuse, right? It's how people give themselves permission to abandon their own moral compass. And it was the silent defense for basically everyone involved in the backdating scandals.
So instead of that lame excuse, Buffett gave his team a really simple but incredibly powerful set of tests. First, he said, don't just ask if something is legal, ask if it's right. And the best way to figure that out is what he calls the front page test. Before you do anything, just imagine a detailed story about it on the front page of your hometown newspaper, where your friends, your family, your neighbors will all read it. If that thought makes you squirm, don't do it. Because in the end, it's a company's culture,
not its rule books, that really decides how people behave.
And that really brings us to the whole point of this story, the big takeaway. This entire scandal, this whole debate, it really just reveals this fundamental clash between two completely different ways of looking at the world. The get-rich-quick scheme that was fueled by stock options versus a true partnership model that's built on shared interests and, basic integrity.
I mean, this table just lays it all out, plain as day. Look at the difference here. You've got Buffett and his partner Charlie Munger. They take a tiny salary, about 100 grand. They take none stock options. All of their wealth comes from one thing: owning the company's stock, just like you or I would. Now compare that to the typical CEO at the center of these scandals. Millions in salary, millions more in options, and a mindset that's all about extracting value from the company for themselves, not creating it alongside their partners.
And for Buffett and Munger, this isn't just about being frugal. It's their entire philosophy. They run Berkshire Hathaway like a partnership. They're in the exact same boat as their shareholders. When the company does well, they get rich with everyone else. When the company does poorly, they feel the exact same pain. Their wins and losses are directly proportional to their partners. It's a get-rich-slowly scheme that's built on actually creating real, lasting value.
And that leaves us with this one last question. And it's a big one that goes way beyond the stock market. The backdating scandal proved that plenty of things can be technically legal, or at least exist in some murky gray area, while still being profoundly, obviously wrong. So it forces us to ask, is the law the only line we shouldn't cross? Or should a real guide be something simpler, something more powerful? Like that front page test, a standard of integrity that says we should only act in ways we'd be proud for the entire world to see.
All right, let's dive right in. Today, we're going to pull back the curtain on one of the most secretive, most hyped-up corners of the financial world: hedge funds. You know the story, right? They promise these elite, secret strategies that can beat the market, but they're only available to the super rich. But here's the thing. Behind all that mystique, behind the genius managers and the secret computer models, the reality is, well, it's a lot more complicated and, frankly, often a lot more disappointing. So let's see what really happens when trillions of dollars meet some pretty wild ambition. This quote, it just nails the heart of the story we're telling today. It's about a fund that was run by a team of certified geniuses. We're talking Nobel Prize winners here. And this is what was said when it all fell apart. It's a story about what happens when you have supreme confidence, incredibly complex math, and then it all just smacks right into the messy, unpredictable real world. It's a huge warning sign that, being the smartest guy in the room doesn't always make you the wisest. Look at this table. Seriously, these 6 numbers tell you almost everything you need to know. On one side, you have long-term capital management, those eggheads we were just talking about. At their peak, your dollar turns into $2.85. Pretty good, right? But then, total implosion. That same dollar shrinks to just 23 cents. Now look at the other side, Warren Buffett's Berkshire Hathaway. Not only did he beat them at their own peak, turning a dollar into almost $4.50, but during the exact same crisis that vaporized LTCM, his investment barely budged. This isn't just a simple comparison, it's a clash of two entirely different universes. So let's start with that story, because it's a true cautionary tale. The collapse of long-term capital management is the perfect example of what happens when brilliance turns into arrogance. I mean, this team was founded by the best of the best, and they honestly believed they had solved the market. They thought they'd built a risk-free money-making machine. And their failure? Well, it didn't just cost their investors a fortune. It nearly took down the entire global financial system. And when I say geniuses, I am not kidding. Just look at this lineup. You've got John Meriwether, a legendary trader. You have not one, but 2 guys who had won the Nobel Prize in economics, the very people who created the formulas the whole world uses. And hey, just for good measure, why not throw in a former vice chairman of the Federal Reserve? You literally could not put together a team with more credentials, more awards, or more of a can't-fail aura. And yet, they flew that fund straight into the side of a mountain. Okay, so if a dream team like that can fail so spectacularly, why are people still so drawn to hedge funds? What is this powerful seduction? Well, it all comes down to a promise, right? The promise of a secret formula, a black box, a money pump that only they have the keys to. A machine that can churn out amazing returns no matter what the market is doing. And that promise, it's what built a multi-trillion-dollar industry. And believe me, that promise is incredibly powerful. By 2008, even after massive public blowups like LTCM, nearly $2 trillion had poured into these funds. I mean, think about that for a second. Investors, including huge pension funds that manage the retirement money for regular people, were dumping trillions into these exclusive, barely regulated funds, all of them chasing that same secret formula. So this is the core concept that a lot of these funds were selling: arbitrage. And in theory, it's a beautiful thing. A true arbitrage is a guaranteed profit with zero risk. It's like finding a $20 bill on the street. No downside, all upside. It's the money pump everyone dreams of finding. But, and this is a huge but, theory and reality are often worlds apart. And this right here, this quote, illustrates the difference perfectly. A true risk-free arbitrage is so rare it might as well be a myth. What most hedge funds call arbitrage is really just a very complicated, very leveraged bet. The source material talks about this top trader who couldn't eat, couldn't sleep because he was so worried about his big arbitrage trade. And that's the bottom line. If you're losing sleep over it, it's not some risk-free money machine. It's a gamble, plain and simple. And to get access to these risky gambles disguised as secret formulas, investors pay a price, a very, very steep price. The standard model is called 2 and 20. That means they take a 2% management fee off the top every single year, whether they make you money or not. And on top of that, they take 20% of any profits. Some funds charge even more. The key takeaway here is that over time, the managers are guaranteed to get rich from the fees alone. The investors, they often end up with what the source brilliantly calls compound fees, not compound interest. All right, so it's time to pull back that secret curtain. What are you really paying for with all those high fees and all that secrecy? I mean, if the strategies aren't truly risk-free, what are you actually buying? The answer, unfortunately, is that you're often buying into a game that is heavily tilted in the manager's favor. Okay, you have to understand this one fundamental, inescapable truth about the market. All the active investors out there, from the biggest hedge funds to the smallest day traders, they're all playing against each other. So before you even think about fees, their average return has to equal the market average. It's just simple math. And what that means is for every hedge fund that has some incredible soaring return, another one has to be crashing and burning just as spectacularly. So if it's a zero-sum game, how do they keep up this image of being winners all the time? Well, there are a few tricks up their sleeve. First, you've got something called survivorship bias. When a fund fails and goes out of business, it just gets erased from the performance charts. So the average return of the funds that are left, the survivors, looks way better than it really is. Then there's creation bias. A manager might start, say, 5 different funds quietly, see which one gets lucky and has a great year, and then market only that one to the public, burying the other 4 failures. And of course, sometimes there's just straight up fraud. People just make the numbers up. And look, when you strip away all that noise, the picture is pretty grim. Forbes was calling this out way back in 2004. They pointed out that once you account for all the tricks and, more importantly, the sky-high fees, the hedge fund industry as a whole was actually doing worse than just buying simple, boring stocks and bonds. Turns out the secret sauce wasn't so secret after all. And if you want to see how truly ugly it can get, you've got to hear the story of the Bayou Group. This wasn't just poor performance. This was a complete fabrication, a massive Ponzi scheme. When the whole thing collapsed, the founder, Samuel Israel, got sentenced to 20 years in prison. But instead of showing up to serve his time, he parks his car on a bridge and tries to fake his own death to escape. I mean, the story is just unbelievable, but it's a real-world example of just how far the deception can go. And this is the detail that just gives you chills. These words, from the theme song of the TV show MASH, were found written in the dust on the hood of his abandoned car. It was just this desperate, theatrical attempt to run away from the consequences of a fraud that had wiped out hundreds of millions of dollars of his investors' money. Okay, so after all that complexity, all that chaos, and all that deception, you have to be asking yourself, is there a better way? And the answer is yes. It's time to talk about the tortoise in our story, Warren Buffett. His approach is the complete, total opposite of the typical hedge fund. It's simple, it's transparent, and it's built to last. And the difference in philosophy? Well, it couldn't be more black and white. Hedge funds build these walls of secrecy. Buffett? He's all about transparency, writing these long, detailed letters to his shareholders every year. Hedge fund managers rake in insane fees. Buffett takes a salary of $100,000. Hedge funds use massive amounts of borrowed money, leverage, to try and boost their returns. Buffett avoids it like the plague, because he knows it's the fastest way to get wiped out. And where hedge funds sell you on their secret black box models, Buffett's strategy is so simple you can write it on a napkin. Buy good businesses at a fair price. And the result of that simple, transparent philosophy, well, it's this number. Just look at it for a second. An overall gain of over 400,000%. It's one of the greatest investment track records in history, and it was done by doing the exact opposite of what the hedge fund playbook tells you to do. No secrets, no crazy leverage, and no charging investors a fortune. It's the ultimate proof that the tortoise can absolutely demolish the hare. So what's the logic behind Buffett's success? It's all captured in this one quote from his mentor, Benjamin Graham. It's about the brutal math of losing money. Think about it. If you double your money, 100% game, and then you lose 50%, you're right back where you started. That's why Buffett is so obsessed with avoiding big losses. He knows that avoiding one catastrophe is way more important than chasing the biggest gain. And this all leads us to the final act, a kind of epic showdown, a moment where these two clashing philosophies were put to a direct, public test. Warren Buffett, who was probably getting tired of hearing about how great hedge funds were, issued a simple public challenge. It became known as the Great Bet. The terms of the bet were just beautifully simple. Buffett wagered $1 million that a boring, passive investment in an S&P 500 index fund, basically just owning a tiny piece of America's 500 biggest companies, would do better than a hand-picked portfolio of hedge funds over 10 years. And here was the kicker. The results would be judged after all of those enormous fees were deducted. He was betting that the fees themselves would be an anchor so heavy that even the so-called geniuses couldn't overcome it. So, the bet was on. A firm called Protege Partners, a company whose entire business was picking winning hedge funds, took him up on it. They each put up some money, with the $1 million prize going to the winner's favorite charity at the end. It was a decade-long showdown, the simplest investing strategy you can imagine versus the most complex and expensive one. And this chart, this shows you the simple, beautiful math that Buffett was betting on. See, before costs, the average return for everyone has to equal the market average. That's bar 1 and bar 2. They're the same. But active investors have costs, right? Trading costs, research costs, and of course those huge fees. Once you subtract all those costs, their average return as a group must fall below the market. That's bar 3. It's a mathematical certainty. Buffett wasn't betting on a hunch, he was betting on arithmetic. And that brings us right back to where we started. We've seen the hype, the spectacular failures, the statistical games, and the staggering costs. We know that active investing is a zero-sum game before fees and a loser's game for most people after fees. So in this world of secret strategies and huge costs, for all the fortunes being made by the managers, who do you think is really paying the price?
You know, when we think about the 2008 financial crisis, it's easy to get lost in the headlines. You remember, right? The bank failures, the stock market just in a free fall day after day. But this whole story, it's not really about numbers on a screen. It's about people. It's about a system that wasn't just broken by accident. No, it was engineered to fail. This is the story of how some of the most powerful people in the world of finance waged a kind of quiet war against the powerless. And to really get how it all went so incredibly wrong, we've got to start with the one guy who saw it coming. Our guide through this whole mess is someone you might not expect, Warren Buffett. But for this, I don't want you to think of him as just the legendary investor. Think of him as an oracle, because 5 full years before the entire global economy nearly imploded, he wrote those exact words. He'd seen it all firsthand through a really disastrous investment in the not-so-glamorous world of manufactured homes. And he saw the rot, a business model based not on smart lending, but on the cynical game of unloading terrible loans on naive lenders. He was basically ringing a giant alarm bell that almost no one on Wall Street wanted to hear. Why? Because they were all drunk on easy money.
All right, so here's how we're going to break this whole catastrophe down. First, we're going to look closely at that early warning from our oracle, Buffett. Then we're going to pull back the curtain on the bad loan machine, this incredible system that created billions of dollars from mortgages that were literally designed to fail. We'll see how the government itself got in on the action, placing a risky bet that made everything worse. After that, things get personal. We'll see the weapons that were used against everyday people. Then the climax, mutually assured destruction. That's when the whole thing just comes crashing down. And finally, we're going to ask the big question. What, if anything, do we actually learn from all this wreckage?
So let's dive into that warning.
Look, Buffett's insight, it didn't come from some magic crystal ball. It came from being down in the trenches of the manufactured housing business, where he made two very, very different bets. One of them went spectacularly wrong, and in that failure, it basically gave him the blueprint for the entire national crisis that was just a few years away.
Okay, so on this screen you see the two paths, the two completely different philosophies that really defined that whole era. On one side you've got Oakwood Homes. Buffett bought their debt, and he later admitted that Oakwood had participated fully in the insanity. Their whole model was just aggressive, fee-driven lending, which, surprise, surprise, led straight to bankruptcy and a total loss for him. But then on the other side, you've got Clayton Homes, a company he later bought outright. Clayton was the total opposite. They practiced sound, prudent, common sense lending. They were profitable, they were well-managed, and here's the kicker. They focused on keeping people in their homes. This isn't just about two companies, you see. It's the choice the entire financial world was facing. Short-term, reckless greed, or long-term, sustainable value. And we all know which path they chose.
So that brings us to the machine itself. See, the problem wasn't just a few bad apples like Oakwood making dumb loans. No, this was a massive, interconnected system, a machine, built specifically to manufacture these toxic loans and then disguise them. The incentives were all wrong. The more loans you could write, who cares about the quality, the more fees you made. This system didn't just tolerate bad loans, it demanded them. It needed them as fuel.
And here's how that machine worked. It's a four-step money train. First, a lender like Oakwood makes a loan they know is awful. Step 2, a giant investment bank like Credit Suisse gives Oakwood a line of credit to go out and make even more of these terrible loans. Now, step 3, and this is the Wall Street magic trick. The bank takes thousands of these toxic loans, bundles them all together, and calls it something new, a mortgage-backed security. And finally, step 4, they sell that shiny new product to so-called sophisticated investors, pension funds, insurance companies, maybe even your own retirement fund. The key here, the most important part, is that the person who owns the risk in the end is now so far removed from the original loan they have no idea what they've actually bought. The risk was just laundered.
So what do you call a system that can only survive as long as new money keeps pouring in to pay off the old guys, even when the business underneath it all is a total failure? Well, our source material calls it what it is, a Ponzi scheme. The money from those new investors buying the mortgage-backed securities was the only thing keeping the old investors, the banks funding the whole operation, from realizing it was all worthless. It created this illusion of fantastic returns, but it was just a house of cards.
And all of this entire complicated mess, brings us back to the most basic rule of lending there is, the Buffett rule. It's so simple it's almost funny. Do not lend money to people who cannot pay you back. An entire multi-trillion-dollar global industry filled with the smartest people in the world decided to just ignore this one basic principle. And in doing so, they basically lit the fuse on a global financial bomb.
But here's the thing. Wall Street wasn't operating in a vacuum. A huge piece of this puzzle is how the referees, the regulators and government agencies that were supposed to be protecting all of us, actually became players in the game. They didn't just look the other way. They actively poured gasoline on the fire.
At the very heart of the government's role were these two behemoths, Fannie Mae and Freddie Mac. Now, technically they were private companies, but everybody on Wall Street knew they had an implied guarantee from the U.S. government. And this created this incredibly dangerous idea called moral hazard, which we know by another name, too big to fail. The market basically believed that no matter how insane their bets got, you, the American taxpayer, would be there to bail them out. And they were right. That safety net encouraged them to take on more and more risk, and under political pressure to expand homeownership no matter the cost, they started lowering their own lending standards, which sent a signal to the entire market that the old rules were officially out the window.
And this table right here just captures the whole shift perfectly. Prudence versus predatory. On the left, you've got the old way. Just common sense, right? You check if someone has a job and income, you make sure they have a down payment, you give them a fixed-rate loan they can actually understand and afford. And then on the right, you have the new normal, which was basically a financial fantasy land. You had stated income loans, better known as liar loans, where you just wrote down whatever you wanted. Zero down payment. And the worst of all, these low teaser rates that looked great for a year or two before they exploded upwards and trapped a borrower.
Okay, so we've talked about systems and we've talked about institutions, but now we need to talk about the people this machine was designed to chew up and spit out, the borrowers. Because these weren't just bad loans, they were predatory financial weapons, specifically designed and aimed at the most vulnerable and powerless people in the country. And the most famous of these weapons was the ninja loan. It literally stands for no income, no job, and no assets. Just let that sink in for a second.
Lenders were handing out hundreds of thousands of dollars to people without even checking if they had a job, an income, or any savings at all. The only thing you needed to get a house was a signature. This wasn't just a bad idea. It was a loan that was absolutely 100% designed to fail from day one.
And then you had this monster, the vampire loan. This was a type of loan where your first few payments were so artificially low, they didn't even cover the interest you owed. So what happened to the rest of the interest? Well, they just added it right back onto your loan balance. It's called negative amortization. It means your loan is actually getting bigger every single month, even while you're making payments. Can you imagine that? Making every payment on time for years, only to find out you owe more money than you did when you started? It literally sucked the equity out of your home, like a vampire.
This was their playbook. First, a tactic called reverse redlining. For decades, banks would draw red lines around minority neighborhoods and refuse to lend there. Well, now they did the opposite. They aggressively targeted those exact same communities, but with the absolute worst, most toxic loans you can imagine. Then you had these so-called no-cost loans, where all the fees were just hidden inside a higher interest rate, costing the borrower tens of thousands more over the life of the loan. As one person in our source material put it, these loans were sold as gifts, but they were actually Trojan horses you could ride to your financial ruin.
So, you've got a system built on a lie, fueled by government-backed risk, and it's preying on the most vulnerable. It was just a matter of time before it all blew up. And because those toxic loans have been chopped up, packaged, and sold to banks and pension funds all over the world, the collapse wasn't going to be small. It was going to be what the military calls MAD, mutually assured destruction. When one part of the machine failed, everyone was going down with it.
And this is how it all started to unravel. The dominoes fell slowly at first. Early 2007, a big subprime lender called New Century goes bust. By that summer, an even bigger one, Countrywide, needs a bailout. Then in 2008, the pace just picks up into a full-blown earthquake. IndyMac Bank fails spectacularly. And then, the unthinkable happens. In September 2008, the U.S. government has to seize control of Fannie Mae and Freddie Mac to stop a complete, total meltdown of the global financial system. The machine had officially broken.
You know what's really stunning? The level of denial from the people in charge, even as this was all happening. In 2007, the chairman of the Federal Reserve, Ben Bernanke, is telling Congress that the total losses would be around $50 to $100 billion. You know, a painful problem, but contained. At the exact same time, the author of our source material was projecting losses nearly 10 times that amount, up to $560 billion. An analyst at the time said, "The market is nervous because everyone feels like they are being lied to." Turns out, they had every reason to be nervous.
And here is a perfect little snapshot of the entire rotten system. You've got Merrill Lynch, one of the biggest names on Wall Street. They had one of their own executives sitting on the board of the shady lender called Own It. Internally, they knew Own It was just hemorrhaging money making these insane no-income verification loans. So did Merrill Lynch put a stop to it? Do they stop buying their junk loans? Nope. They kept buying Own It's toxic waste, packaging it and selling it to unsuspecting investors without ever telling them about the massive conflict of interest or the true risk. It's just unbelievable.
So, after the bailouts, after the millions of foreclosures, after a global recession that wiped out trillions of dollars in wealth, you have to ask the most important question of all. Did we learn anything? The system was shattered, and then we pieced it back together with taxpayer money. But was the underlying sickness, that culture of reckless, incentivized greed, was it ever really cured?
Let's go back to where we started and look at the final results. For the industry that chased those insane profits, the outcome was a catastrophe. Millions of foreclosures, a huge transfer of wealth from the poor to the rich, bankruptcies, bailouts, the works. And the result for Clayton Homes, the company that just stuck to boring, sensible lending? Their $11 billion loan portfolio performed great. Delinquencies and losses stayed low, right through the crisis. They proved without a doubt that you didn't have to cheat people to make a profit. Sound, ethical business was always the better model.
So did the banks that survived change their ways? Well, not exactly. Instead of really cleaning up their act, a lot of them just started playing accounting games. The new motto became, if you don't like the numbers, just change the definition. For example, if you have too many loans that are 90 days late, what do? Simple. You just change the rule so a loan isn't officially delinquent until it's 180 days late. Fannie and Freddie apparently decided to wait 2 years before they would write down a bad loan. Instead of cleaning up the mess, they just tried to hide it.
And this brings us back one last time to our oracle, Warren Buffett. And just a final piece of proof of his incredible foresight. Get this, at the end of 1999, Berkshire Hathaway was Freddie Mac's biggest shareholder. Just 1 year later, he had sold almost all of it. Why? Because he saw that management had become obsessed with hitting this arbitrary 15% annual growth target. And he knew that to hit that number year after year, they would eventually have to start taking dumb, dangerous risks with their loans. He saw the disaster coming almost a decade before it hit, not because of some magic formula, but because he understood a simple truth. Chasing impossible numbers always leads to reckless behavior.
And that leaves us right here with this final, critical question. The crisis led to bailouts, and it led to some new rules, sure, but did it actually change the fundamental nature of the game? Did it cure what a former Fed chairman once called the infectious greed that just takes over Wall Street from time to time? The incentives to take huge risks for short-term bonuses, those are still there. The banks are now even bigger. It kind of feels like we just patched up the machine, leaving it ready for the next cycle of boom and bust, with the powerful once again pitted against the powerless. And that's something to think about.
All right, let's talk about the giant, elaborate magic trick that nearly broke the entire world economy back in 2008. This isn't just a story about boring finance. Nope. This is about a full-blown shell game played with trillions of our dollars by some of the smartest people on the planet. We're going to peel back the curtain and see exactly how they used mind-numbing complexity to hide a disaster in plain sight. So how do you even start to wrap your head around this mess? Well, Warren Buffett, probably the most famous investor in the world, tells you everything you need to know right here. 750,000 pages. I mean, just let that sink in. That isn't a mistake. That's not just thoroughness. That's a weapon. The whole crisis was built on a foundation of pure, baffling complexity, a wall of paper built so high that nobody, not even him, could see what was really going on. So, here's how we're going to break this all down. We're starting with that crazy 750,000-page problem. Then, we'll get to the bad box of candy at the center of it all. We'll see how they cooked up this disaster, find out why the watchdogs were asleep at the wheel, watch it all come crushing down, and then end with Buffett's simple, powerful truth. Right, the 750,000-page problem. You have to understand, this wasn't just dense financial writing. It was a fortress of jargon, built on purpose. It was designed to intimidate, to make you feel stupid, to make you give up before you even started. The whole point was confusion, because when everyone's confused, nobody asks the right questions. And let's be crystal clear about this. The complexity wasn't a bug. It was the main feature. I mean, we're talking about huge, sophisticated hedge funds that had to go out and hire other experts just to try and figure out what the heck they were buying. It created this fog where nobody could see anything clearly. The real message was, hey, don't worry about what's in the box. Just look at the shiny AAA-rated sticker on the outside. And that blind trust, that's exactly what the whole system depended on. So what was actually in the box? What was this thing at the heart of the crisis? It's called a collateralized debt obligation, or a CDO. But forget the jargon. You don't need a finance degree for this, I promise. All you need to do is picture a simple box of chocolates. Yeah, I know, that definition sounds like a mouthful. A pool of assets repackaged into tranches. It's designed to sound complicated, but it's not. At its core, it's just a bunch of loans, mostly mortgages, all bundled together and then sliced up to be sold off. Just stick with that candy box idea, and it'll all make sense. Okay, so here's the secret recipe. First, you go out and you collect thousands and thousands of loans. Some are good, safe loans. Some are not so good. And some are just plain awful subprime loans. Step 2, you throw them all into one big box and mix them up. The big idea was, hey, a few bad candies won't spoil the whole box, right? Then you slice the box into layers, sell them off, and this is the key. You get the rating agencies to slap a beautiful AAA rating on the top slices, making them look as safe as gold. But here's where the whole thing just falls apart. What happens when the box isn't just a few bad candies? What happens when you open it up and find it's mostly filled with, well, wrappers? And the few pieces of candy that are left already have bite marks in them. That's what these things became. They were just boxes of financial garbage, dressed up to look like a premium product. You thought that was bad? Oh, just you wait. They didn't stop there. This is where the whole thing goes from reckless to completely insane. If the first CDO was a bad box of candy, the next version was basically a box of poison from the get-go. So, just to recap, level 1, you have your basic CDO. It's a mix of real loans from real houses. A questionable mix for sure, but at least it's tied to something in the real world. Then you get to level 2, the CDO squared. This is just bonkers. You take the absolute worst, most toxic, guaranteed to fail slices from a bunch of other CDOs, and you glue them together to make a brand new product. Think about that. You're literally building something new out of the rejected garbage of other products. And then you get to the final boss, the synthetic CDO. At this point, we've totally left reality behind. There are no loans here, no houses, nothing real. These were just bets on other bets. It was a purely imaginary casino built on a mountain of risk so tangled and complex, no one on Earth could figure it out. So how did they get away with selling this stuff? It was basically a club. Imagine you're a bank and you're sitting on a pile of this toxic junk that nobody wants. What do? Simple. You call your buddy at another bank who has the exact same problem. You swap your garbage for his garbage, mix it all up so no one knows where it came from, and then you take it to a friendly rating agency that, for a nice fee, will stamp it AA. And just like that, you've turned garbage into gold and can sell it to some poor pension fund. So I know what you're asking. I mean, it's the obvious question. Where on earth were the regulators? Where were the cops on the beat? The SEC? How was this even legal? The answer is pretty terrifying. They were asleep. Or maybe they just chose to look the other way. You just have to look at this timeline from 2005. It tells you everything. This is right when the whole powder keg was about to blow. Bear Stearns is being investigated for doing exactly this stuff. And what happens? The New York Attorney General drops the case. The SEC's own investigation just kind of disappears. The path was totally clear for the banks to go wild. It was a complete and total system failure. Every single check and balance that was supposed to protect us just evaporated. The SEC backed off. The rating agencies, as one banker put it, were just eager for fees and got bullied into giving good ratings. The guys managing these things, often unregulated and totally clueless. And the lawyers, well, they just wrote fine print that gave the banks a license to kill. Every line of defense was gone. So, the house of cards was built higher and higher, and nobody was watching the store. What happened next was not just predictable, it was inevitable. When this fragile system finally started to wobble, it didn't just crack, it completely shattered. The first bill came due in June of 2008. The first wave of losses was almost $400 billion. Just gone, wiped off the books of the biggest banks in the world. And believe it or not, that was just the appetizer. Because just 4 months later, boom, that number exploded. It jumped past $660 billion. The speed at which this wealth was just vanishing into thin air, it was absolutely terrifying. And even that huge number doesn't tell the whole story. Not even close. That was just the bank losses. It didn't count the city governments that went broke, the pension funds that were gutted, the retirement accounts that were wiped out. When the dust finally settled, the IMF's best guess for the total damage was nearly $1 trillion. And these weren't just abstract numbers, these were household names. This is the Hall of Shame. Look at this. Wachovia, almost $100 billion in losses. Merrill Lynch, Citigroup, WAMU, more than $50 billion each. These weren't just bad quarters, folks. These were company-killing, history-making catastrophes. This quote just nails it, doesn't it? It perfectly describes how it all fell apart. Imagine a mountain climber feeling perfectly safe because of all their gear. But then one support snaps, then another. And that final buckle, the one everyone swore was the strongest, the one that was AAA rated, that's the one that breaks and sends everything plunging into the abyss. So after all that, after the jargon, the schemes, the collapse, what are we left with? When you strip it all away, what's the actual lesson here? You know, what's amazing is that behind those 750,000 pages of nonsense, the truth is incredibly simple. You can invent all the fancy names you want, synthetic, CDO squared, SIV light, it doesn't matter. You can't change 2 basic, timeless rules. Rule 1, don't lend money to people who can't pay you back. And rule 2, for all of us, if you do not understand something, do not invest in it, period. And this whole saga leaves us with one big, nagging question, one that's maybe more relevant today than ever. We're always told that financial innovation is a good thing, that it drives the economy forward. But you have to ask yourself, at what point does that innovation cross a line? When does it stop being a tool and start being a weapon of mass destruction? That's something worth thinking about.
Back in 2008, it felt like the entire global financial system just had a heart attack. Investments that were supposedly risk-free, the safest you could possibly get, completely evaporated. And that kicked off a meltdown that cost millions of people their homes, their jobs, their life savings. The question that still hangs in the air today is, how on earth did the safest investments in the world suddenly become the most toxic? Well, let's dig in.
So let's frame this whole thing around a really simple idea from Warren Buffett: accountability. If they did the wrong thing, they should go. It's a pretty straightforward principle, right? But as we're about to find out, for the people at the very center of the 2008 crisis, it was a principle that was almost completely ignored.
Okay, to really get a sense of the sheer scale of what we're talking about, just look at this number: $2 trillion. That's how big the market was for something called a collateralized debt obligation, a CDO. Just imagine taking thousands of different mortgages, the good, the bad, and yeah, the really, really ugly, and bundling them all together into one giant investment product. This wasn't some tiny niche market. This was a monster at the very heart of the global economy, and it was about to go nuclear. To get to the bottom of all this, here's our game plan. We're going to start with the AAA implosion itself. Then we'll meet the so-called gatekeepers of risk. After that, we'll pull back the curtain on what our source material calls the junk science factory that was powering their ratings. We'll look at the warnings that everyone ignored, see how this all crushed Main Street, and finally ask the big question: why hasn't the system really changed?
All right, let's kick things off with the core of the mystery, the collapse of these AAA-rated assets. Now that rating, AAA, is supposed to be the financial world's equivalent of a flawless diamond. It's meant to be indestructible, incredibly safe. But in 2008, those diamonds didn't just crack, they shattered into dust.
I mean, look at this chart. It shows you just how fast this whole thing exploded. The market goes from about $275 billion in the year 2000 to an absolutely staggering $2 trillion just 7 years later. That's not healthy growth, that's a speculative frenzy. And then, the crash. By mid-2008, more than $200 billion worth of these things were in default. It was a rocket ship that ran out of fuel and came screaming back down to Earth.
So, who was in the cockpit of this rocket ship? Who was giving all of these unbelievably risky products the highest possible stamp of approval? Well, that brings us to our next stop, the gatekeepers of risk.
You see, in the world of finance, it really all came down to three companies: Moody's, S&P, and Fitch. These guys weren't just big players. They were officially blessed by the US government. That meant huge pension funds, mutual funds, all sorts of major investors were often legally required to buy products that these three agencies gave a thumbs up to. This created a massive bottleneck, a powerful cartel. If you wanted to play in the big leagues, you had to get their blessing. They were the only judges in town.
So what exactly was a AAA rating supposed to mean? Well, whether it was Moody's AAA or S&P's AAA, the message to you, the investor, was crystal clear. This is as safe as it gets. It's an ironclad guarantee. It was supposed to mean you had an almost zero chance of losing your money. Now remember that definition of safety, because it's about to get turned completely upside down.
So if these agencies were the official judges of risk, the gatekeepers, how in the world did they get it so catastrophically wrong? Let's go to our next section and pry open the doors to what our source calls the junk science factory and see how the sausage was really being made.
Okay, so the first ingredient in this toxic stew was something the author calls financial astrology. The agencies were trying to rate brand new, incredibly complex mortgage products, many of which had never existed before, but they were using historical data from old-school, simple mortgages. It was literally like trying to navigate Los Angeles rush hour traffic using a map from the 1920s. The old data just didn't apply to the new reality. Next up in the factory, financial alchemy. When they didn't have the right data, which, let's be honest, was most of the time, they pretty much just guessed. They were taking these giant pools of risky subprime mortgages, financial lead basically, and through their fancy models, they were magically turning them into AAA-rated gold. The only problem is, alchemy isn't real, and neither were these ratings.
And the third ingredient, financial phrenology. Now, if you don't know, phrenology was this old, totally bogus 19th century science where people claimed they could judge your character by feeling the bumps on your skull. And that's exactly what the agencies were doing here. They were giving their stamp of approval to the people managing these massive funds without doing any real serious background checks on who they were or if they knew what they were doing. They just looked at the outside and assumed everything was fine.
And look, if you think this is just me being dramatic or some outside critic, check this out. This isn't from a critic. This is from an internal email at S&P in 2007. An analyst is complaining about a deal, and their colleague basically says they have to rate everything. It could be structured by cows, and we would rate it. That one email tells you everything you need to know about the culture, right? It wasn't about getting the risk right. It was about cashing the checks and slapping a rating on whatever came through the door.
All right, so you might be thinking, well, okay, but nobody could have seen this coming, right? It was a total black swan event. That's a nice story, but it's just not true. The alarms were blaring for years, which brings us to our next section, the warnings that everybody empowered chose to ignore.
And who better to make this point than the Oracle of Omaha himself, Warren Buffett? His whole philosophy has always been simple. Do your own homework. Actually understand what it is you're buying. He never ever outsourced his thinking to the rating agencies because he knew their stamp of approval was no substitute for real, fundamental understanding. If only more people had taken that advice.
And this wasn't just some vague feeling in the air. The source for this analysis details a very specific trail of ignored warnings. Look at this. As early as 2003, the author published a book pointing out the massive holes in the rating models. By 2006, there was a public warning in the Financial Times. By February 2007, a direct letter went to the top regulator, the SEC, calling these ratings smoke and mirrors. Each warning got louder and more urgent, and each one was ignored. The machine just kept running, right up until the moment it flew apart.
And this is so important. This wasn't just some abstract game played by bankers in fancy suits. The fallout from all this junk science and, frankly, willful ignorance was devastatingly real for regular people. Let's move on and see how Wall Street's failure became Main Street's absolute nightmare.
Let's just take one real-world example, the city of Springfield, Massachusetts. The city invested almost $14 million of public money into 3 of these CDOs, and they did it for one simple reason. They were rated AAA. They were told it was the safest investment possible. 6 months later, that $13.9 million investment was worth just $1.2 million, a catastrophic loss of nearly 90%. This was taxpayer money, money for schools, roads, fire departments, and it was just gone.
And Springfield was far from alone. The pain from this spread absolutely everywhere. We're talking pension funds, that's teachers and firefighters' retirement money. We're talking cities and towns across the country. We're talking mutual funds where everyday people were saving for college or for a house. Banks, insurance companies, the very foundations of our financial system were all loaded up with this safe, toxic sludge.
Which brings us full circle, right back to that word we started with, accountability. After all this devastation, after a crisis that brought the entire world to its knees, was the system actually fixed? Did the people responsible finally face the consequences? Let's take a look at the aftermath in our final section.
So, what are the big lessons from this whole mess? Well, first, that a label like AAA can be worse than useless. It can be a dangerous illusion. Second, the Buffett rule. Never just trust, always verify. Understand what you own. Third, a huge conflict of interest, where the agencies are being caved by the very companies they were supposed to be rating, is a recipe for total disaster. And maybe the most troubling lesson of all, the very same big 3 agencies are still in charge today, and the big banks that sold all this junk largely walked away without any real accountability.
And that leaves us with a really unsettling final thought. The very same gatekeepers who failed so spectacularly, who used junk science to light the fuse on the global economy, are still the official judges of risk today. The same cartel is still in place. So you have to ask yourself, is the next global financial disaster right now sitting in a pension fund somewhere with a shiny, reassuring, and completely meaningless AAA rating attached to it?
Welcome to The Explainer. Today, we're going to pull back the curtain on a story from 2007. It's about 2 hedge funds, and their spectacular, fiery collapse was really the first major tremor, that warning shot, before the entire global financial system came crashing down. And believe me, this isn't just a story about boring spreadsheets. It's about ego, it's about greed, and it's about the exact moment Wall Street's whole house of cards started to wobble. And you know, there's no better place to start than with this gem from Warren Buffett, because this one idea, leverage, is the absolute heart of this story. It's the rocket fuel. It's what turns a small, manageable fire into a full-blown, catastrophic inferno. And boy, were these two funds about to become the textbook example of how not to play with fire. So here's our roadmap. We'll start with the first warning signs that everyone was ignoring. Then we'll do a quick breakdown of leverage, that financial dynamite we just mentioned. After that, we dive into Bear Stearns' massive, risky bet, watch the whole thing come apart at the seams, and finally, we'll see exactly why this one failure was the first domino that toppled the rest of Wall Street. All right, let's get into it. The year is 2007, and if you were paying close attention, you could see the housing market was starting to look really, really sick. But the big shots on Wall Street, well, they were either looking the other way or, even crazier, they were telling all their clients to just keep buying. I mean, look at this timeline. The signs were everywhere, and they were getting impossible to ignore. You had experts on TV screaming about problems. You had huge mortgage companies like New Century literally going up in smoke. Giant banks like HSBC were announcing billion-dollar losses. And in the middle of all that chaos, what was Bear Stearns doing? They were actually upgrading the stock of a company that would be completely bankrupt a month later. You can't make this stuff up. The denial was just, wow. And this is where it gets really interesting. It's like there were two completely different realities. In one, you had smart, contrarian investors like Jim Meltzer who saw the writing on the wall. They bet against the market and, get this, tripled their money. And in the other reality, you had the official research from Bear Stearns telling their own paying customers to do the exact opposite. Go long, they said. Buy more. It was just a total disconnect from what was actually happening. Okay, so to really understand how this whole thing went from a small problem to an absolute catastrophe, we have to hit pause and talk about the single most important concept in this entire saga: leverage. Think of it as the secret sauce, the hidden amplifier that makes the good times great and the bad times, well, absolutely devastating. So what the heck is financial leverage? Simply put, it's just using borrowed money to invest, right? The idea is that you can magnify your profits, but, and this is the big but, it also magnifies your losses in a huge and frankly terrifying way. And this little example with a house shows you exactly how dangerous it is. Let's say you buy $1 million house. You put down $100,000 of your own cash. Now, if the value of that house drops by just 5%, not that much, right? You've actually lost half of your original investment. $50,000, gone. And if that house price drops 10%, your entire $100,000 investment is completely wiped out. Poof, gone to zero. It's an express elevator straight to the basement. So, let's bring it back to our story. The houses that Bear Stearns was buying, well, they weren't actual houses. They were these ridiculously complex things called collateralized debt obligations, or CDOs. All you need to know is that they were basically giant lasagna dishes packed with thousands of mortgages, a lot of them the risky subprime kind, all bundled together. And these CDOs, well, their value was about to drop by a whole lot more than 10%. Okay, so now we know what they were buying, these sketchy CDOs, and we know how they were buying them, with tons of borrowed money. So let's zoom in on the two specific Bear Stearns hedge funds that were right in the eye of this hurricane, run by a guy who was about to become very, very famous for all the wrong reasons. So the strategy, run by the star manager Ralph Ciaffi, sounded great on paper. You buy these CDOs that the ratings agencies stamped as super safe, and then you use massive leverage. We're talking borrowing up to $20 for every $1 you actually have. As long as prices kept going up, this thing printed money, and the returns were incredible. The problem? There was zero margin for error. Absolutely none. And then this huge red flag pops up. The funds plan to launch a new public company, an IPO, called EverQuest. Now, IPOs are supposed to be about transparency, right? Bringing things out into the light. But when reporters started digging through the paperwork for this one, they found the exact opposite. It was a complete maze of sketchy conflicts of interest, and it basically revealed that the whole game was rigged. So let me see if I've got this straight. Bear Stearns was essentially grading its own homework, coming up with its own values for these assets that nobody else could price. Then they were selling those assets from one pocket, their hedge funds, to another pocket, this new company that they also controlled. And buried in the fine print was the fact that it was all stuffed with the riskiest of the risky subprime junk. Oh, and they made it nearly impossible for investors to get their money out or fire them. What could possibly go wrong? And this is just incredible. After some of these problems were reported, the fund manager himself Ralph Cioffi gets on the phone with a journalist, and he basically says, hey, it would be really great for you if you said you quoted me out of context. It was a not-so-subtle threat, and it just shows you how much pressure was building up behind the scenes. They were desperate to keep the game going. So the secret was getting out. The market was turning sour. And that beautifully engineered money-printing machine they had built, well, it was about to fly apart in the most spectacular way imaginable. This is where the wheels come off. It started with a number that seemed, okay, not great, but not a disaster. On May 15th, they told investors that the fund had lost about 6.75% in April. For people used to making huge gains, that stung, sure, but it wasn't the end of the world. Or so they thought. But then, just a few weeks later, they had to send out another letter. A little correction. Turns out the real loss for April wasn't under 7%. It was almost 19%, nearly 3 times worse than what they had first reported. The banks lending them all that money were finally starting to mark the assets to their real value, and the truth was just brutal. And that revised number? That was the fire alarm. It caused sheer panic among the big banks that had loaned them billions. They all started making margin calls, which is basically Wall Street's version of a frantic phone call saying, hey, the stuff you gave us as collateral isn't worth squat anymore. We need more cash or more assets from you right now. Now, the fund's response to this crisis was, and I'm not exaggerating, a masterclass in what not to do. First, they slammed the emergency exit shut on their own investors, freezing redemptions so nobody could pull their money out. And then, and this is the height of arrogance, they went back to the very banks demanding money and basically said, hey guys, could you just stop asking for your money back? And also, could you maybe lend us some more? Well, you can probably guess how that went over. That stunning arrogance backfired completely. The bank said, no way, and they seized the assets to sell them for pennies on the dollar. And just like that, the first big, noisy domino of the subprime crisis had officially fallen over. So what was the final bill for the people who had trusted them with their savings? It was total annihilation. If you were in the riskier enhanced leverage fund, you lost every single penny. A complete wipeout. 100% gone. If you were in the supposedly safer fund, you got a dime back for every dollar you put in. A 90% loss. And what about the guys who ran the show? Well, Ralph Cioffi, the manager, ended up getting indicted. Warren Spector, the co-president of the whole firm, was famously canned while he was out of town playing in a bridge tournament. And the CEO, Jimmy Kane, he was eventually forced to resign after losing almost $1 billion of his own personal fortune that was tied up in the company's stock. But you see, the really huge story here wasn't just about 2 bad hedge funds. It's that their collapse suddenly exposed Wall Street's dirtiest secret. When the banks tried to sell off all those seized CDOs, they found out there was no market. Nobody wanted them at any price. And that was the horrifying moment when every other big bank had to look in the mirror and realize, oh no, our basements are filled with the exact same toxic junk. The real panic was just getting started. You know, in the end, this little Wall Street joke about the card game bridge might just be the most perfect and most chilling summary of the entire crisis. It's a story about misplaced faith, about systems so complex that nobody, not even the people running them, really understood them. And it's a story about partners who just assumed that somebody else knew what they were doing. Turns out they didn't, and the rest of the world was about to find that out the hard way. All right, today we're talking about dead man's curve. It's that really treacherous spot in high finance where everything can go wrong, and in 2008, it did. We're going to look at how leverage, pure speculation, and just a total crisis of confidence sent the entire global economy spinning right off the road. It's a heck of a story about how a few deeply connected players, betting billions of dollars they didn't have, nearly brought the whole system crashing down. You know, to really get what happened, we got to start with a really fundamental idea, and Warren Buffett just nails it here. In one corner, you've got his philosophy, right? Understand what you're buying, its real, actual value. And in the other corner, you have Wall Street's super complex models, which, more often than not, were just trying to guess which way the market would jump next, instead of looking at what something was actually worth. This clash of ideas, it's right at the very heart of the 2008 crisis. So this slide here, it breaks down the 2 warring ideas perfectly. Over on the left, you've got value investing. Think Benjamin Graham, think Buffett. It's all about doing your homework, rolling up your sleeves, and buying something for less than it's truly worth. But on the right, you've got market timing. Now, this is a different game. This is about trying to predict where prices are going to go, usually based on what they did in the past. And as we're about to see, betting that history is just going to repeat itself, well, that can lead to what Graham called a speculator's financial results. And trust me, that's not a compliment.
Okay, so here's our game plan. We're going to start with the very first domino to fall, a hedge fund called Peloton. Then we'll see how its collapse sent shivers through a much bigger, much more connected firm, Carlyle. And that's going to lead us right to the edge with the investment bank Bear Stearns, which forced the Federal Reserve to do something pretty incredible. And then at the end, we're going to ask the big question. Did we actually learn anything from all this?
So let's get right into it with that first domino. See, our story doesn't begin at some giant bank you've heard of. Nope, it starts at a celebrated hedge fund out of London called Peloton Partners. And at the time, these guys were seen as just about the smartest people in the room. In their credentials, absolutely top tier. I mean, they were started by ex-Goldman partners. Their $2 billion fund, the Peloton ABS fund, pulled in an absolutely astonishing 87.6% return in 2007. When they announced that number at an award show, people in the room literally gasped. It was that unbelievable. The press even started calling them hedgy heroes. These guys were at the absolute peak of their game. Now here's the crazy part. They made all that money in 2007 by correctly betting against the subprime mortgage mess. They saw it coming. But then, for their next trick, they made a U-turn, a really fatal one. They looked at all these supposedly highly rated mortgage securities that had taken a hit, and they bet a fortune that they just bounce right back to their old historical prices. It was a classic market timers bet, and it completely ignored the fact that if you actually looked at what was in those securities, they were rotten to the core. So how did they make such a huge bet? Well, they used a weapon of financial mass destruction, leverage. This slide breaks it down really simply. Imagine you want to buy $1 million worth of something, anything. You only put up $200,000 of your own cash. The bank loans you the other $800,000. Now, if your assets lose just 5% of their value, the bank gets real nervous. They hit you with a margin call, demanding you put up more cash. If you can't, they sell your stuff. And if the value drops by 25%, poof, your entire $200,000 is completely gone, and now the bank itself is losing money. This is exactly what happened to Peloton, but on a scale of billions of dollars. And the collapse, it was breathtakingly fast. I mean, in January, they're literally on stage getting a big award. A little over a month later, February 25th, the mortgage markets they'd bet on just fall off a cliff. They get the margin calls, they scramble to sell assets to raise cash, and they discover nobody's buying. It was a fire in a crowded theater. 3 days later, it was all over. The bank seized everything, from hero to zero in what felt like a blink of an eye. So you might be thinking, okay, a hedge fund blew up. It happens, right? Not the first time, won't be the last. But why did this one single event send shockwaves through the entire global financial system? Well, the answer is all about who Peloton owed money to, and the terrifying fear that the same exact problem was hiding on other, much, much bigger balance sheets. And to see how this thing snowballed, you just have to follow the fear. The banks that loaned money to Peloton, they were now stuck with all these worthless assets. And that made them get real nervous about anyone else playing the same high-leverage game. And that brings us to our next player, the Carlyle Group, a massive private equity firm with some very deep connections in Washington. So Carlyle had this fund called Carlyle Capital Corporation, or CCC. And just look at these numbers. They were juggling almost $23 billion in assets, but with less than $1 billion of their investors' actual money. That is a leverage ratio of 24-1. They weren't just on a tightrope, they were on a greased-up piece of dental floss over the Grand Canyon. So what does that really mean? It's crucial to get this. With that insane level of leverage, even a tiny little dip in the value of their assets would be an absolute catastrophe. All it would take, was a 4% drop in the value of their portfolio to completely 100% wipe out every single penny of their investors' capital. 4%. And, well, you can probably guess what happened next. It was Peloton all over again. The market for those mortgage assets kept getting worse. By early March, Carlyle got hammered with $400 million in margin calls that it just couldn't pay. The exact same pattern was repeating, but this time, the numbers were just way, way bigger. The failure of Carlyle Capital just lit the whole market on fire. And why? Because one of its biggest creditors, one of the banks now holding the bag, was the 5th largest investment bank in the entire United States, Bear Stearns. Suddenly, the market smelled blood in the water, and what started as rumors turned into a full-blown crisis of confidence.
So as these rumors started flying that Bear Stearns was about to run out of cash, the company did what companies always do in the situation. They went on the offensive. On March 10th, they put out this statement, forcefully denying everything. They insisted their balance sheet was a rock, that they had plenty of cash. It was a classic move to try and calm a market that was starting to totally panic. But talk is cheap. This slide shows you the market's real verdict. Forget the press releases. The true story was in the credit markets. And basically, nobody, and I mean nobody, was willing to sell insurance on Bear Stearns anymore. It's like trying to buy fire insurance when your house is already burning down. The market was screaming that a Bear Stearns default wasn't just possible, it was probable. And the final days, wow, it was just a complete whirlwind. On Monday the 10th, you have the official denial. On Wednesday the 12th, the CEO is on TV on CNBC claiming they have a $17 billion liquidity cushion. By Friday the 14th, that cushion had completely vanished, and they needed an emergency loan from the Fed just to open for business. And by Sunday the 16th, the whole firm was sold to JP Morgan Chase for just $2 a share, $2. The collapse of a huge Wall Street bank like Bear Stearns threatened a complete chain reaction, a domino effect that could have taken down the entire system. And to stop that from happening, the U.S. Federal Reserve did something that had never been done before. They basically invented this thing called the Term Securities Lending Facility, or TSLF. Let me break it down. The Fed offered to lend up to $200 billion of super safe U.S. Treasury bonds. In return, banks could give the Fed their toxic mortgage junk as collateral, the very same stuff nobody else would touch. And here's the really crucial part. This was the first time the Fed had ever extended this kind of safety net beyond regular commercial banks to the investment banks that were at the very center of the fire. And as you can imagine, this was hugely controversial, right from the start. As our source material puts it, this created a massive moral hazard. In other words, the Fed was bailing out the bad guys. They were essentially rewarding the exact same institutions whose crazy risk-taking created the whole mess, which sends a pretty dangerous message, right? It tells them there are no real consequences for failure if you're big enough. But for the actual shareholders of Bear Stearns, oh, there were consequences. This table just lays out the brutal, brutal reality. Early 2007, the stock is over $130. That initial emergency bid from JP Morgan? $2. After some haggling, they got it up to $10. It was an almost complete and total wipeout for anyone who owned the stock. A very painful lesson in what happens when leverage goes back. So after all that, the chaos, the collapse, the bailouts, we have to come right back to where we started. We have to revisit that fundamental fight between two completely opposite ways of looking at the financial world. So on one side, you've got the Buffett way. Don't get buried in debt, actually look at what you're buying, and focus on its real long-term value. And on the other side, you've got the speculators game that took down Peloton, Carlyle, and Bear Stearns. That's a game built on mountains of borrowed money, totally ignoring that the assets were junk, and just praying that the market would keep going up forever. What happened in 2008 was a painful, expensive, real-world lesson that proved Buffett's principles were right all along. And all of this leaves us with the billion-dollar question, doesn't it? The government and the Fed, they stepped in and stopped a complete meltdown in '08. But by saving the system, did they also save the very speculative culture that almost destroyed it? By creating a safety net for the biggest players, have we just kicked the can down the road and guaranteed that another, maybe even bigger, crisis is waiting for us, just around the next dead man's curve? The 2008 financial crisis, it wasn't just some abstract event on a stock chart. When you really dig into it, it feels more like a detective story. A story about a massive crime with clues and warnings that were hidden in plain sight or maybe just flat out ignored. So today, we're going to put on our detective hats and follow that trail right up to the moment the whole system came crashing down. Now this sounds like something you'd hear in a schoolyard, right? But believe me, on Wall Street, this isn't just an insult. This is throwing down the gauntlet. It's a public accusation that a company's financial statements, the very numbers they live and die by, are basically fiction. This single sentence, well, it was the first shot fired in a war over what was real and what wasn't. So here's our game plan. First, we're going to look at that warning that everyone chose to ignore. Then, we'll watch as the first cracks start to show. We'll meet the guy they called Bazooka Hank, who was trying to hold the line. And then, and this is the fun part, we're going to pry open the black box of accounting tricks they were using. After that, we'll relive the weekend all the dominoes fell, and finally, see what Wall Street looked like when the dust settled.
All right, so let's set the scene. It's August 2007. Yeah, the markets feel a little jittery, but for the most part, the giants of Wall Street seem invincible. That is, until someone stands up and publicly calls out one of the biggest insurance companies on the planet, AIG. And the charge? That AIG was basically cooking its books, hiding the true risk of its bets. And this right here, this is the heart of the whole dispute. AIG was making two really bold claims. First, they said these incredibly complex bets they made, called derivatives, were so unique and special that you couldn't actually put a real market price on them. Second, they swore up and down that the portfolio of risky home loans they were insuring was so rock solid, so safe, they'd never have to pay out. But here's the thing about accounting rules. They don't care about your feelings. You have to value your assets at what the market says they're worth, not what you wish they were worth. So what was AIG's detailed, data-driven rebuttal to this very serious charge? 2 words: we disagree. That's it. This wasn't a defense, it was a dismissal. It was basically Wall Street's way of saying, "Nuh-uh, you're the liar." And just like that, the battle lines were drawn. Okay, let's jump ahead to early 2008. Because a war of words is one thing, but pretty soon, AIG's own quarterly reports started to tell a story that was just impossible to argue with. That initial warning was about to be proven right in the most brutal way you can imagine, with huge, undeniable, jaw-dropping losses. And there it is, a loss of $5.3 billion in a single quarter. Now, for a company the size of AIG, this wasn't just a bad quarter, this was a 5-alarm fire. The cracks that nobody could see were suddenly becoming giant chasms. And just when you're thinking, wow, that's bad, the next quarter comes along, a loss of $7.8 billion. You see the trend here, right? This wasn't a slip-up anymore. This was a nosedive, and it was accelerating. The company's own numbers were screaming that something was desperately wrong. Let's just tally this up. In just a couple of quarters, AIG was forced to admit to over $20 billion in write-downs on the very things they swore were perfectly safe. And then came the final nail in their credibility coffin. Their own auditor, the group that's paid to check their math, found a material weakness. Now, in plain English, that's accounting speak for, we can't trust these numbers anymore. By the summer of 2008, everyone started to realize that this wasn't just an AIG problem. This disease was spreading. The fear was no longer about one company going under. The real terror was that the whole global financial system was so tangled together that one big failure could pull everything else down with it. And this is where we meet Treasury Secretary Hank Paulson, who got the nickname Bazooka Hank because of this very quote. He was desperately trying to convince Congress to give him the authority to bail out the mortgage giants Fannie Mae and Freddie Mac. His whole point was about psychology. He thought if the markets just knew the government had this overwhelming financial firepower, this bazooka, that fear alone would be enough to calm everyone down. And this is the concept that was keeping everyone up at night: systemic risk. Just think about it. AIG had sold insurance policies on over $440 billion worth of assets owned by banks all over the globe. So if AIG couldn't pay up, all of those banks would take a massive hit, all at the same time. It wasn't just one domino, it was the center domino in a pattern that covered the entire world. Okay, before we get to the grand finale, we have to pause and look at the murder weapon. How did all of this risk get hidden so effectively? Well, the answer is in the very dry, very complicated world of accounting, which, back then, had become a kind of magic trick. It all comes down to these 3 levels. Level 1 is simple. Think of a stock, like Apple. You can look up its price any second of the day. It's real. Level 2 gets a bit fuzzier. You're using a computer model, but at least the inputs, like interest rates, are real things you can see. But level 3, oh boy, that's the danger zone. That's where management could use their own secret models with their own secret inputs. It was a total black box. You just had to take their word for it. They called it mark to myth for a reason. And nobody put a finer point on how absurd this all was than Warren Buffett. He quipped that he'd give a lot to mark his own weight to model instead of to market, the actual scale. It's funny, but it's a perfect takedown of the entire mindset, valuing something based on your own fantasy instead of cold, hard reality. So here's the craziest part of the story. You'd think the regulators, the financial cops on the beat, would be trying to shut this down, right? Nope. In March of 2008, the SEC actually sent out a letter encouraging companies to use this level 3 black box accounting.
And the result? Predictable. Banks started shoveling assets into the mark-to-myth category as fast as they could. I mean, look at Merrill Lynch. They jacked up their level 3 assets by 70% in 3 months. The refs were basically telling the players it was okay to hide the ball.
Okay, let's get back to the timeline. We've seen the weapon, that accounting black box. Now we're about to see it go off. All across Wall Street, these hidden bombs had turned the entire financial system into a house of cards. And in September of 2008, that house of cards met a hurricane. And the speed of it was just stunning. September 7th, a Sunday, the government takes over Fannie and Freddie. Exactly 1 week later, on another Sunday, Bank of America is forced into a fire sale marriage with a collapsing Merrill Lynch. The very next morning, Monday the 15th, Lehman Brothers, a pillar of Wall Street for 158 years, is gone. Bankrupt. And by that afternoon, the Fed realizes AIG is the final critical domino and pumps in $85 billion just to stop the world from ending. It was a complete and total meltdown. So, after all that smoke cleared, the world looked different. The Wall Street that had existed just a week before was gone. The old model was completely shattered, and the lessons were incredibly clear, especially when you compare the companies that blew up with the ones that survived.
And this really lays it all out. You had 2 totally different philosophies. On one side, you have the investment banks, built on insane amounts of debt, their books filled with those black box assets, and a culture that was just all about revenue, no matter the risk. And on the other side, you have a company like Berkshire Hathaway. Very little debt, always looking for real underlying value, and an absolute refusal to overpay for anything. One was a casino, the other was a business.
And this table, well, it's pretty much the obituary for that era. Lehman, gone. Merrill Lynch and Bear Stearns swallowed up in emergency sales. And the 2 survivors, Goldman Sachs and Morgan Stanley, had to completely change their business models just to stay alive, becoming heavily regulated bank holding companies. The freewheeling, independent investment bank was officially extinct.
So if you only take one thing away from this entire mess, let it be this. A company's reported numbers can be an illusion. A profit in one quarter can be a fantasy. The only thing that truly matters in the long run, the only thing that separates the survivors from the tombstones, is a company's real, tangible, underlying value.
And that leaves us with one pretty unsettling question, doesn't it? The names on the doors of the big banks have changed, but has the fundamental game changed with them? Because there are still trillions of dollars in assets out there being valued with these same black box methods. So how can we really be sure we can trust the numbers this time? And that's something we're thinking about.
All right, we're about to dig into a really crucial but kind of forgotten piece of the 2008 financial crisis. This is the story of how the very companies that were supposed to be the guardians of safety, the ones designed to protect our investments, ended up doing the exact opposite. They basically put Main Street on a direct collision course with Wall Street.
So here's our game plan. We're going to start with a market that almost overnight just froze solid. Then we'll look at the broken promise that was supposed to keep it safe. We'll uncover the sickness deep inside the system and hear about the warnings that pretty much everyone ignored. And then we'll contrast all that chaos with a masterclass in how to actually do this stuff right and pull out the big lesson.
Okay, so let's set the scene. It's early 2008. There's this market out there that everyone treats like a savings account, only better. It's supposed to be completely dependable. And then, one day, it just stops. This wasn't some weird, risky corner of the financial world. This was the auction rate securities market. And it's where huge institutions parked their cash to keep it safe.
$330 billion. Let that number sink in. That's how big this market was. I mean, this was the go-to place for everybody, from tech giants like Google all the way down to small condo associations, just to park their cash somewhere safe and liquid and maybe earn a little extra interest.
And that was the promise, right? This was the sales pitch. For countless investors, we're talking big corporations, pension funds, all looking for a safe harbor. They were told this stuff was the next best thing to a treasury bill. The whole system was built on one simple idea. You could get your money out whenever you wanted.
And then, boom, February 2008, the unthinkable happens. The whole market just seizes up. The big investment banks, the ones who promised they'd always be there to buy these things back, they just walked away. 70% of the market failed like overnight. All of a sudden, investors were stuck holding assets they couldn't sell. And the cities and towns that use this market, their interest costs went through the roof, which meant they were looking at having to raise taxes on regular people.
So, you've got to ask yourself, how in the world does an investment that's just like cash simply freeze up like that? Well, the answer lies with the companies that were supposed to be the ultimate safety net, the absolute bedrock of this market, the bond insurers. Now, their job, at least on paper, was beautifully simple. You pay them a fee, and they guarantee that if you buy a bond, you're going to get your money back no matter what. It was called credit enhancement, and its whole purpose was to make a good investment totally ironclad. You know, what's really fascinating here is the sheer power in these three little letters. AAA. This was the highest, most coveted rating you could get, and the big bond insurers all had it. It was like the ultimate seal of financial approval, a stamp that just screamed to the entire world, this is perfectly, 100% safe. And the market was so built on that trust that people just stopped doing their homework. Why look too closely at what you're buying when that AAA rating does all the thinking for you? But here's the thing. Behind that perfect, pristine AAA rating, a really reckless habit had taken over. These companies, which were once super conservative, had basically abandoned their principles. They made a massive gamble that was going to put the entire financial system at risk. And this quote just perfectly captures the problem. They were insuring the absolute riskiest, junkiest financial products out there, but treating them like they were the safest city bonds you could find. And the worst part? They were charging way, way too little to take on all that incredible risk.
So what was this toxic junk they were insuring? Well, it wasn't safe bonds for building roads or schools. Oh no. They were guaranteeing these incredibly complex products built on the shakiest, most questionable part of the mortgage market. Things called CDOs, and even crazier, CDOs squared, which were literally just bundles of risk wrapped up inside other bundles of risk.
By January of 2008, the market was starting to figure out that something was deeply, deeply wrong. I mean, when one of the giant insurers, MBIA, had to go out and borrow money, they had to pay a 14% interest rate. At the same time, safe government bonds were paying less than 4%. Like Warren Buffett said at the time, this was a screaming signal from the market that nobody actually believed their AAA rating was real anymore. Now, this is the really crucial part. This whole disaster, it didn't come out of nowhere. It might have shocked most people, but there was a small group of really smart investors and analysts who had been sounding the alarm for years. They were basically yelling that the emperor had no clothes, but nobody wanted to listen. People like Bill Ackman, David Einhorn, Janet Tavakoli, they were the Cassandras of this crisis. They actually did the hard work. They did the math, they looked at what was inside these products, and they went out in public and asked, how on earth can these companies have a AAA rating when they're insuring a mountain of subprime garbage? And Ackman, he took it a step further. He did something pretty radical. He somehow got his hands on this spreadsheet that detailed the insurer's portfolio of risky assets. And he called it horrifying, and he just posted it on the internet for everyone to see. He made the hidden danger completely transparent. Then, a real shockwave came from the government itself. New York's top insurance regulator, a guy named Eric Dinalo, he got all the big Wall Street banks in a room and pointed out something critical. He said, hey, if the mortgages that are backing all these products were based on fraud, well, then the insurance contracts on them might be totally void. And you could just feel the panic. The banks suddenly realized that all that risk they thought they had passed off to someone else might be coming right back to them. Okay, so as this whole house of cards is starting to fall apart, one legendary investor sees not just chaos, but a huge opportunity. And he did it by sticking to simple insurance principles that have been around for centuries. It's really an amazing contrast. While the rest of the market was in a complete hair-on-fire panic, Warren Buffett's Berkshire Hathaway was the picture of calm. They had a real, earned, trusted, AAA rating. They absolutely refused to insure bad business just to make a quick buck. And instead of desperately needing cash, they were sitting on a mountain of it, just patiently waiting for the right time to make their move. And, you know, Buffett's philosophy wasn't some new, complex financial trick. Its roots go all the way back to Benjamin Franklin. After a huge fire ripped through Philadelphia, Franklin realized, you know, prevention is the best thing, but for the risks you can't prevent, you need insurance. And that insurance has to be priced correctly. Berkshire Hathaway was just taking Franklin's 250-year-old wisdom and applying it to today's market. The reward for having all this discipline is this amazing thing called float. Think of it like a river of cash. It's all the premiums the insurance company collects before it has to pay out any claims.
Now, in the hands of a disciplined insurer and a brilliant investor like Buffett, that float can be invested and compounded over time into just staggering amounts of money. It's the secret engine behind his whole operation.
So when you look at the chaos of that fake manufactured safety on one side and the calm, genuine wisdom on the other, what's the ultimate lesson we're supposed to take away from this whole mess?
Well, Buffett's approach is really a masterclass in risk. First, never, ever chase growth just for the sake of it by taking on bad business. Second, only take on a risk when you're being paid properly for it. And maybe most importantly, understand that super fast growth can actually be a huge red flag, a sign of undisciplined underwriting, not success. In the end, it all comes down to a simple equation. Make sure the money coming in the door is more than the money that will eventually have to go out.
And maybe this is the biggest lesson of all. He understood this fundamental truth about finance and, frankly, about human nature. Whenever profits look way too easy and they're based on accounting gimmicks instead of real value, it's going to attract the wrong kind of people, and it will always, always end in disaster.
And all of that leaves us with a really critical question for right now. I mean, this story is from 2008, but our financial world is still filled with incredibly complex products and easy promises. And understanding the difference between a real guarantee, one that's backed by discipline and prudence, and a fake one that was just manufactured with the stroke of a pen, well, that's more important today than it has ever been.
You know, when most people think about the 2008 financial crisis, they picture this sudden, shocking collapse, some kind of black swan event that nobody could have possibly seen coming. But the thing is, if you really dig into what people were saying back then, the truth is, well, it's a lot more unsettling. This wasn't an accident. This was a disaster unfolding in slow motion, one that some of the sharpest minds in finance were watching happen in real time, and they were totally powerless to stop it. And the story of how it all went down is a pretty chilling lesson in just how fragile our whole financial system really is. And really, there's no better way to set the stage than with this quote from Warren Buffett. Now, you got to remember, this was said in May of 2008. That's months before Lehman Brothers collapsed and the whole world seemed to fall apart. This wasn't hindsight. This was a warning from right inside the storm. What Buffett was saying was that the system had grown so complicated, so out of control, that the very things designed to keep it safe were basically useless. The genie was out of the bottle, and it was about to cause some serious damage. So how did that genie get out? Well, we're going to break it all down. Here's what we'll cover. First, we'll look at the warnings that everyone seemed to ignore. Then we're going to go back to basics and talk about the 3 kinds of money, the very foundation of our economy. After that, we'll see how the system's watchdogs completely fell asleep at the wheel. We'll explore the incredibly controversial bailouts and the dangerous precedent they set. And finally, we'll tally up the absolutely staggering bill that got left behind for everyone else to pay. All right, first up, the warnings. And believe me, they were loud and clear for anyone who was listening. By the spring of 2008, you had a lot of officials still trying to tell the public that everything was going to be okay, but at the same time, Warren Buffett was on TV saying flat out that the U.S. was already in a recession. And he warned that it would be, in his exact words, deeper and last longer than many think. The official numbers hadn't caught up yet, but the reality on the ground, it was obvious. The economy was in trouble. And look, this wasn't your garden variety recession. The U.S. was staring down the barrel of this particularly nasty thing called stagflation. Think of it like a two-front war on your wallet. On one side, the economy is grinding to a halt, which means fewer jobs and wages aren't going up. But on the other side, inflation is taking off, so every single dollar you have buys you less at the grocery store, less at the gas pump. It's like being caught in an economic vice grip, and it was squeezing everyday people hard. So the big question is, how on earth did we get here? Well, the source material points to a whole series of really bad policy decisions. It all kicked off when Washington decided to keep interest rates artificially low for way too long. This flood of what they call easy money didn't just stimulate the economy. It kicked off a total frenzy of speculation, terrible lending practices, and even outright fraud. And the regulators, the people who were supposed to be the referees in all this, they basically became enablers. All of this inflated a gigantic housing bubble, and when that thing inevitably burst, the average American was left holding the bag, with crushing debt and a dollar that was worth less and less every single day. At the end of the day, this was a complete failure to protect the value of our money. And that idea, protecting the value of our money, that's really at the heart of this whole thing. Because to really get how the system broke, you have to go back to basics and ask a super simple but really important question. What is money? I know, it seems obvious, but the differences between the three basic types are absolutely central to this entire story.
Okay, so first you've got commodity money. This is the oldest kind, the most intuitive. It's an actual object that has value all by itself. Gold is the classic example, right? You can't just print more gold. And even today, long after we left the gold standard, central banks all over the world still hoard physical gold. Why? Because it's seen as the ultimate backstop of value for when faith in everything else just collapses.
Then you've got the second type, credit money. This isn't a physical thing, right? It's a promise. When you write a personal check, that's credit money. It only has value because the person you give it to trusts that the money is in your account. The source material actually has a perfect example of this, Warren Buffett's Berkshire Hathaway. The company has such an amazing reputation and brings in so much cash, we're talking like $100 million a week, that its credit, its promise to pay, is considered absolutely ironclad. Trust is everything here. And that brings us to the third type, and this is the big one. This is what our entire modern economy is built on, fiat money. The US dollar is a perfect example of fiat money. It's not backed by gold or silver or anything tangible. It only has value because the US government declares it legal tender and, crucially, because the rest of the world believes in the full faith and credit of the United States. Its entire value is based on trust. And right here, this comparison, this is where you see the core vulnerability of our entire system. Commodity money, like gold, has value in and of itself. But fiat money, like the dollar, doesn't. Its value can be watered down, it can be debased, it can even be totally destroyed by bad government policies, by printing way too much of it, or by running up insane amounts of debt. So when the government failed to regulate the system and then printed trillions to bail it out, they were directly attacking the very foundation of trust that gives the dollar its value in the first place. Okay, so if the whole system is built on trust and rules, what happens when the referees, the regulators, just stop calling the game? What happens when they just leave the field entirely? That's what we're getting into next, the catastrophic failure of this whole alphabet soup of agencies that were supposed to be our watchdogs. There's this analogy in the source material that just perfectly sums up how absurd it all was. It said watching the regulators was like watching a really bad game of doubles tennis. You had all these different agencies, the SEC, the Fed, you name it, and every single one of them just assumed someone else was going to deal with the exploding crisis in mortgage-backed securities. There was no coordination, no one took responsibility, everyone just assumed the other guy would get the ball. And so, in the end, nobody did. The ball just dropped. And the timing of what happened next? I mean, you almost couldn't make this up. There was this guy, Eliot Spitzer, the governor of New York. They called him the Sheriff of Wall Street because he was so aggressive in prosecuting financial crimes. On Valentine's Day 2008, he publishes this scathing article blaming federal regulators for the whole mess. Less than a month later, his career is completely destroyed by a personal scandal. And get this, on March 17th, the exact day his resignation became effective, the Federal Reserve announced the massive bailout of Bear Stearns. At the precise moment the system needed its toughest critic the most, he was gone. Which of course leads us straight to the bailouts. This is really the moment the crisis stopped being a Wall Street problem and became everyone's problem. The government decided to step in to save these massive private companies, which basically meant socializing all of their risks after they had privatized the profits for years. The precedent this set would change absolutely everything. So the first big domino to get propped up was Bear Stearns. The thinking was that they had to prevent a disorderly failure. Basically, a chaotic collapse that could take down a bunch of other firms with it. So the Federal Reserve stepped in and took on $30 billion of Bear Stearns' absolute worst, most toxic mortgage assets. The source material calls these things a sticky bomb. And that's the perfect image. It was a live explosive, and now it was stuck right on the American taxpayer's balance sheet. And the clock on that bomb started ticking down almost right away. And this one act unleashed this really corrosive, really dangerous idea into the financial system. It's called moral hazard. And this is probably one of the most important concepts you need to understand from this whole crisis. It's pretty simple. If you protect people or companies from the consequences of their own risky decisions, what do you think they're going to do in the future? They're going to be even more reckless? I mean, why would you play it safe if you know that when you gamble and lose, someone else, in this case the taxpayer, is going to show up and cover all your losses? And look, this wasn't just some critic on the outside yelling about this. This warning came from inside the Federal Reserve. The president of the Philadelphia Fed, a guy named Charles Plosser, he saw the danger right away. He argued that by bailing out Bear Stearns' creditors, the Fed was sending a crystal clear message to the rest of Wall Street. Go ahead, take all the risks you want, we've got your back. He was worried, and he was right, that they were basically just sowing the seeds for an even bigger crisis somewhere down the road. So all of this, the bad loans, the failed regulators, the bailouts, it all leads us to our final and, frankly, pretty sobering section, the legacy. Because after the dust from the bailouts finally started to settle, the American public was left looking at a bill that was almost impossible to even comprehend. This debt didn't just appear overnight, but the crisis, and especially the response to it, basically strapped a rocket to it. So first, just take a look at the two mortgage giants, Fannie Mae and Freddie Mac. By the spring of '08, these two companies, which were sponsored by the government, had combined obligations of $5.3 trillion. To give you some perspective, that's about the same amount as all of the outstanding U.S. government bonds in the entire world at the time. They were absolutely massive, they were incredibly leveraged, and they were right on the edge of collapse before the government finally had to take them over completely. All right, then there's the U.S. national debt itself, which hit $9 trillion back in 2008. And when you break that down per person, it's just staggering. We're talking about a bill of about $38,000 for every single man, woman, and child in the United States. That's a debt that our kids and our grandkids are still going to have to work to pay off. But honestly, even that $9 trillion number doesn't capture the whole picture, not even close. At the time, the Government Accountability Office reported that when you factored in all the unfunded promises for things like Social Security and Medicare, the total fiscal burden on the United States was an astronomical $52.7 trillion. And the truly terrifying part? This thing was growing on autopilot, adding $3 to $4 trillion in new obligations every single year without anyone doing a thing. That is the real legacy, a slow-motion financial threat that is still with us today. It all comes back to this central dilemma, and honestly, Thomas Jefferson nailed it centuries ago. The government stepping in felt necessary at the time to stop a complete and total meltdown. But a government that's powerful enough to bail out the entire financial system, to give Wall Street everything it wanted, is also a government that's powerful enough to rack up unimaginable debt, to devalue its own currency, and to shift all of that risk onto the shoulders of its citizens. And so that brings us right back to where we started, with Warren Buffett's warning about the genie and the bottle. This crisis laid bare some really fundamental flaws in our system. Our total reliance on money that's only backed by faith, regulators who failed to do their job, and the incredibly dangerous precedent of bailouts that just create more moral hazard. The interventions, they might have stopped the immediate freefall, but they came at a massive cost. So you have to ask yourself, more than a decade later, after all the new rules and all the reforms, have we really put that genie back in the bottle? Or is it still out there, just waiting? You know, it's amazing how one single investment decision, just one, can pull back the curtain on decades of incredibly complex history. That's what we're going to do today. We're going to look at one of Warren Buffett's boldest international moves and use it as a lens to understand the thick, confusing fogs of war, religion, and politics in the Middle East. This, right here, this is the kind of question that shows you why Warren Buffett is different. While everyone on Wall Street was buried in spreadsheets, he was thinking about these huge, fundamental risks. I mean, what if the internet just stopped? It's not about the market going up or down, it's about the very foundation of how we do business. And that mindset, well, it's absolutely key to the story we're about to get into. All right, let's wind the clock back a bit. We're in the mid-2000s. The financial world is just on fire. Everything's booming. But Buffett, he sees something else coming. He's worried about the US dollar getting weaker, and he needs a strategy that was definitely not what everybody else was doing. And this is where it gets really interesting. Look at the two paths here. On one side, you have pretty much all of Wall Street. They're making a killing by slicing and dicing mortgages, creating these super complex hedge funds. It's all very abstract. And then you have Buffett doing the complete opposite. He's hunting for real companies outside America that make actual physical things and get paid in currencies other than the dollar. So while everyone else zigged toward Wall Street wizardry, he zagged toward tangible international businesses. Classic Buffett. And that hunt leads him right here to this deal. It starts pretty simply. In late 2005, the chairman of an Israeli company called iScar, a guy named Eitan Wertheimer, just writes a letter to Buffett. That's it. By May of the next year, they've got a deal. And then, boom, just 2 months later, on July 5th, it's done. Berkshire pays $4 billion for an 80% stake. That is a huge bet, a long, long way from his home in Omaha.
So why this company? Why iScar? Well, when you look at it, it just ticks all the boxes. It makes something the world absolutely needs, these really high-tech cutting tools. Perfect. It makes money in more than 60 different countries, which is a fantastic hedge against that weak dollar he was worried about. It had great family management that was sticking around. And, fascinatingly, it was a major employer of Arab Israelis, a real cornerstone of the local community. There was just one tiny catch. Its main factory was just 7.5 miles from the border with Lebanon.
Now, Buffett knew the region was volatile. Of course he did. He even said that as long as there wasn't a war, Israel was basically as safe as the U.S. The problem, as you can imagine, is that you're never guaranteed there won't be a war. Just let that sink in for a second. $4 billion. The ink on the contracts is barely dry, and literally 1 week later, 7 days, all-out war explodes right on the company's doorstep. I mean, you can't make this stuff up. And we're not talking about some abstract threat happening miles away. This was real, and it was immediate. Hezbollah rockets started raining down, and they were landing in the very same industrial park where Buffett's new $4 billion baby was located. The ultimate stress test had just begun, whether he liked it or not. The war raged for 33 pretty brutal days. iScar actually had to shut down its plant for a few of them, but miraculously, it didn't suffer any major damage. The fighting eventually stopped with a UN resolution that called for a ceasefire. But here's the really important part. That resolution also demanded that Hezbollah disarm, and that just never happened. So the fighting stopped, but the root cause of the conflict, it was still there. The business survived, but the risk was very much alive. To really get why this risk is so baked into the region, we have to pull the lens way, way back. Because that war in 2006, it wasn't some random event. No, it's just one chapter in a much, much longer story. A story that's deeply connected to the history of Iran and its complicated relationship with the West. Okay, let's go all the way back to 1953. For the first time, Iran has a democratically elected leader, Prime Minister Mohammad Mossadegh. One of his first big moves is to say, hey, our oil should belong to us, and he nationalizes the industry, which had been controlled by the British. Well, Britain and the US didn't like that one bit. So the CIA and MI6 cook up a plan, they stage a coup, and they kick out the elected government. In its place, they reinstall the Shah, a dictator who they knew would play ball. In this single event, it planted decades of deep and frankly justifiable suspicion of the West inside Iran. The Shah's rule eventually crumbled, leading to the Islamic Revolution in 1979. And to understand the kind of pure terror of that time, we need to focus on the story of just one man, Habib el-Ghananian. He was a leader in Iran's Jewish community, a brilliant industrialist, one of the richest men in the whole country. In a lot of ways, he represented everything modern and successful about Iran before the revolution. But that success, it made him a target. After the revolution, they put him on this televised show trial. This eyewitness account, it's just bone-chilling to read. Just try to picture it. You have no lawyer, your accusers are spitting questions at you, and before you can even get a word out, they answer their own questions for you, twisting everything into an accusation. It wasn't a trial, it was theater, designed to send a message. The outcome was never in doubt. He was executed, branded a Zionist spy, and his death was used as the excuse for the new regime to just seize his entire vast fortune. His story is just this gut-wrenching reminder of the ultimate risk of doing business in that part of the world, where politics and religion can take away not just everything you own, but your life itself. All right, let's shift gears a little bit. We've been looking through the fog of Middle Eastern politics. Now let's turn our attention to what the source material for this story calls the American fog, the absolutely massive and often incredibly mismanaged U.S. presence in that very same region. Take a look at these numbers from the Iraq War, which was happening at the same time Buffett was buying iScar. The war was costing $8 billion a month. By the end of 2006, the total cost was over $400 billion. But the number that just floors me is this last one, $12 billion in cash, literally cash, shrink-wrapped on pallets and flown to Iraq for reconstruction projects, just vanished. Poof, gone. But the disconnect, it wasn't just about money. This table right here, this might be even more shocking. This shows the staff at the U.S. Embassy in Baghdad. Out of 1,000 people, 1,000 people making critical, strategic decisions in an Arabic-speaking country, how many do you think were fluent in Arabic? 6. Just 6. That's not a communication gap. That's a complete and total failure to understand the very culture you're trying to influence.
And that failure to understand is so dangerous, because this is a region that is fractured along fault lines that are centuries, sometimes millennia old. This is the fog of religion and identity.
At the absolute core of so many of the modern conflicts is a split within Islam that happened way back in the 7th century, right after the Prophet Muhammad died. It boils down to this. Sunni believe the next leader should be chosen by the community. Shiites believe leadership had to pass down through Muhammad's bloodline. This one disagreement from over 1,400 years ago is still a massive driver of geopolitics today, especially in the rivalry between Sunni Saudi Arabia and Shiite Iran.
Now, look at how this plays out on the ground in a country like Iraq. The population is about 55% Shia and 45% Sunni. For decades, the Sunni minority was in charge, but when the U.S. invaded and toppled that government, it flipped the whole power structure upside down, putting the Shia majority in control and, by extension, strengthening their allies in neighboring Iran. Understanding this simple chart is honestly the key to understanding the last 2 decades of Middle Eastern history. But here's the thing. It's not just about Sunni versus Shia. That's too simple. There are all these other layers of identity, all overlapping. You've got the ethnic divide, Arab versus Persian. The language divide, Arabic versus Farsi. You've got nationalist groups like the Kurds, who don't see themselves as Arab or Turk or Persian. And then you get these fascinating contradictions, like Iranians, who proudly identify as Aryan, but also trace their religious lineage back to the Prophet Muhammad, who was an Arab. It's an incredibly complex and beautiful tapestry. So, we have the fog of war, the fog of deep-seated politics, the fog of ancient religion. It is a chaotic, unpredictable, and frankly messy environment. So let's bring it all back to where we started, that summer of 2006. And let's see how 2 very different ways of investing held up in the middle of all this chaos. And this, right here, this is the punchline. On one hand, you have a Bear Stearns hedge fund, something with a nice, safe-sounding name like High Grade, operating right in the heart of the global financial system. Within a year, it was completely wiped out. Gone. On the other hand, you have Buffett's factory in Israel, literally under rocket attack, and it delivers a gain of over 20%. It just goes to show you that what we think is risky and what is actually risky can be 2 totally different things.
You see, Buffett's bet on ISCAR, it wasn't a bet that there was no risk. He knew the risks. It was a bet on value. It was a bet on a real business with great managers, making a real product that the world needed, a business so strong it could survive the inevitable fogs of war, religion, and politics. And that really leaves us with a big question, doesn't it? In a world that seems to be getting foggier and more confusing every day, where do we even begin to look for real, lasting value?
What if I told you that one of the biggest lessons from Warren Buffett has almost nothing to do with picking stocks? I mean, you'd think a lunch with the man would be all about financial secrets, right? Well, today we're diving into a story that pulls back the curtain on how one of the greatest investors of all time really thinks. And it's not just about money, it's about what makes a life genuinely valuable. So let's start with this quote. Now, this is Buffett talking about his own mentor, Benjamin Graham. And just listen to those words. No score kept generosity. That doesn't sound like Wall Street talk, does it? This right here, this is the key to everything we're going to talk about. It points to a kind of wealth you can't track on a stock ticker. It's the foundation for a much bigger idea of what it means to be rich.
Okay, so let's dive into Section 1, A Lunch with Buffett. Our story really kicks off with the author of our source material here. He has this one lunch with Warren Buffett, and that's it. His entire way of looking at the world, at value, just completely shifts. It wasn't just a memorable meal, It was one of those pivot point conversations that just recalibrates your whole compass.
And here was the big aha moment. The author realizes, wait a minute, all these principles Buffett uses to find good, solid, undervalued companies, you can use that as a blueprint for your own life. It's a move from just a financial strategy to a full-on life philosophy. How do you build a durable, satisfying life? Well, maybe you do it the same way you find a durable, great business. All right, let's get our hands dirty with a real-world example. Section 2, the Berkshire shortcut. To really understand how Buffett thinks, the author came up with what he calls a lazy shortcut for figuring out what Berkshire Hathaway is actually worth. It's a surprisingly simple way to cut through all the noise and just see the powerful engine humming underneath.
So first, just a real quick refresher on the core idea here: value investing. Look, it's not about trying to time the market, it's not about chasing trends, it's about doing the homework to figure out what a business is really worth deep down, and then having the patience to buy it for less than that. It's a philosophy built on substance, not speculation.
Okay, so part 1 of the shortcut. This number, $90,600 per share. This comes straight from Buffett's own 2007 letter to shareholders. Think of this as the value of all the stocks and bonds that Berkshire owns. It's like their giant investment portfolio, the foundation of the whole thing.
Now, for part 2, this $4,093 a share, this is different. This isn't from their stock portfolio. This is the earnings power from the actual businesses they own and run. You know, companies like See's Candies and Benjamin Moore Paints. These are the cash-generating machines. So you've got the pile of investments, and then you've got the engines that are constantly making more money.
So how do we stick them together? It's ridiculously simple. Step 1, you grab that big investment value, the 90 grand. Step 2, you put a price tag on that stream of earnings. A 10x multiple is a pretty standard conservative way of doing that. So you take that 4,000 something and multiply by 10. And then you just add them up. That's it. It's a quick back-of-the-napkin calculation, but it gets you right to the heart of the matter.
And check this out. It doesn't even really matter if you use that conservative 10x multiple or a more generous 15x. Either way, you land on a value well into 6 figures. See, the exact number isn't the point. The point is that you can see, with simple math, that there is an enormous mountain of tangible value here, completely separate from whatever the stock price is doing on any given day.
And that's the real takeaway here. This little exercise isn't about being a math genius. It's about proving to yourself that there's real, incredible substance behind the stock. And once you know that, once you really feel it, you can just calmly ignore the market's daily mood swings. It gives you the psychological anchor you need to stay the course.
Okay, so we've got the financial side down. Now let's see how this idea builds into something so much bigger. We're moving on to Section 3, more than money. We're about to shift from value on a balance sheet to the value of a person's character. And you'll see they are deeply, deeply connected.
So the author draws this really sharp contrast between two different ways to operate. On one side, you've got value investing, the Berkshire model. It's steady, provides peace of mind, you buy something great and you just hold it. On the other side, you've got the world of M&A, mergers and acquisitions. It's all about the short-term gain, the quick takeover. It can be lucrative for sure, but man, it's exhausting. You're always on the hunt for the next deal.
And that brings us to this incredible, real-world dilemma. The author's nephew has a business that's thriving, a business he loves to run. And then boom, he gets a massive offer to sell, a truly life-changing payout. So what does he do? Does he take the money, or does he stick with the rewarding work of building his company? It's that classic head versus heart problem. So the author actually puts this question to Buffett himself.
Buffett's answer is it's astonishing. He doesn't talk about financial multiples. He doesn't talk about exit strategies. He just says he actually envied the nephew. Envied him. Why? Because the nephew had found something that millions of people search their whole lives for, fulfilling work that he was passionate about. In Buffett's eyes, that was a kind of wealth that money just can't buy. He valued the daily journey over the one-time destination.
And this is the moment that just perfectly illustrates the whole point. The author realized Buffett's true wealth wasn't just his billions. It was his freedom to live on his own terms. It was his focus on putting money back into real businesses. It was his generosity in spending time to help a complete stranger's nephew. And get this, he's giving this thoughtful advice while at the same time secretly finalizing one of the largest charitable donations in human history. The scale of his thinking is just on another level.
So let's pull all these threads together. Let's wrap this up in Section 4, a clearer view of value. What does this mix of financial logic and personal character teach us about finding what's real and important in our own lives?
And here is the central lesson. The real purpose of a sound financial strategy like value investing, it isn't just to pile up more money. The real purpose is to achieve a level of peace and security that frees up your single most valuable asset, your time. So you can then invest that time in the people and the passions you truly care about. The money is just the tool, freedom is the goal.
Buffett's mentor, Benjamin Graham, wrote this fantastic line. He was talking about the hype
and the groupthink that can just take over financial centers. The idea is, the farther you can get from that constant echo chamber, where everyone is chasing the same frantic idea, the more clearly you can actually think for yourself.
And this is the final, powerful insight. The author connects that idea directly to Buffett, who lives in Omaha, Nebraska, literally 1,269 miles from Wall Street. But here's the kicker. You don't have to physically move. The real journey is to create that distance in your own mind, to separate yourself from the short-term noise and the social pressure so you can gain a clear perspective on what really matters.
And that leaves us with a pretty important question to think about. This isn't just about Wall Street, is it? It could be the constant chatter of social media, a toxic job, or just an unhealthy obsession with what other people think. We all have our own Wall Street. So what is the noise in your life that you need to move 1,269 miles away from to get a clearer view of what's truly valuable to you?